Ladies and gentlemen, put your hands together for your MC for day 2, Miss Gugu Mfupi.
Good morning, everybody. Welcome to day 2 of AMC 2026. Excited to see many of you back in the room. You're the ones who made it, to make sure that we follow up on the key conversations that we established just yesterday. And perhaps before we dash into an overview, I'm quite keen to see some of the key points that might have stood out for many of you. And as you can tell, we really are looking to hear some of your feedback in terms of the themes, the critical conversations, the outcomes, the keynote addresses, and even the questions that might have left you lingering post the conversations and panel discussions around how best it is that we move forward and engage. So perhaps just to open it up to the floor, happy for you just to shout out any key themes that stood out for you. No eye contact doesn't mean I won't maintain the eye contact, but I promise this is not a lecture hall. But any key themes that stood out for you in terms of growth, maybe comments on currency, reserve currencies for central banks that need to be mindful of, critical analysis as well in terms of understanding growth objectives and which particular regions might be thriving. Critical raw materials came out for you, and that stood out quite significantly. Definitely a theme that we'll follow up on. Thank you, sir. Appreciate your feedback. I'm also cognizant you might be saying that because you represent Zambia. So, again, a market that does well in that, right? Anything that stood out for you in particular, sir? Yep, might as well speak to you. Infrastructure. 100%, really be important, especially given some of the themes that came through regarding digital infrastructure within construction, energy, and of course understanding the water concerns we have. My eyes have landed on you, sir, if you'll indulge me. Governance. 100%. Governance and of course policy, a sense of continuation and clarity in terms of those outcomes. And I can imagine that these are many themes that resonate with many of you. Thank you for assisting me and, of course, collaborating and sharing some of your perspective, because today we look to build up on those conversations. The foundation was set and made very clear that the continent is one filled with potential. And whilst conversations have been ongoing, it is important and imperative that we prioritize the action. We heard from various representatives regarding the infrastructure dynamics and, of course, growth opportunities that exist, but more so also understanding the reality of mobilizing that capital on the ground. Not without its challenges, but with new innovative solutions as to how best we navigate it. We heard further insight as well as to how best it is that we prepare ourselves for the global shifts and dynamics. And our keynote speaker, the 8th Secretary General of the United Nations, Mr. Ban Ki-moon, elaborated on the fact that we do need to share our voices more robustly, confidently, in sharing some perspectives as to what it is that we agree or might not agree with in terms of the shifts in the dynamics. So this sets the tone and the theme for what it is that we look to build up on here at the AMC 2026 for today's conversation. Today we take it further and take a look at new areas and sectors that have been showing robust levels of growth and, most importantly, also instill a heightened level of confidence. We'll talk about payment solutions that are coming forth and how that is evolving and shaping the continent. We'll talk about digital technology and AI. And we'll also continue to engage robustly with key leaders of various countries across the continent who continue to give us insight into their vision, but more so, we'll be able to interrogate that further by having investment sessions with them and critically asking questions around new opportunities and partnerships that we can delve into. So the likes of Botswana, Zambia, Angola, Ethiopia, and Zimbabwe, just to name a few countries, will be featured in terms of the conversations that will take place after lunch in breakaway sessions, building up on the visions that they've shared with us. Again, we strongly encourage your engagement and appreciate the feedback that many of you have shared, especially in the Q&A sessions with our panelists. In the interest of time, we will be cognizant of the fact that today is a logistical day for many of us who are present here at the conference. So we will do our best to endeavor to keep to time and, most importantly, facilitating the adequate movement and flow of not only speakers and moderators up and down the stage, but also your participation. During the tea breaks and the lunch breaks, we ask that you promptly make your way in and out of the sessions just to ensure the adequate flow of the program and a timeliest end for all of us to ensure that logistical and travel arrangements can be covered. On that note, ladies and gentlemen, thank you once again for joining us for AMC 2026, Day 2, where we look to build up on these themes. Our online audience, for many of you who are participating and joining us, thank you again for your time. Keep your comments and your feedback coming as we look to engage further on much of the conversations we share. Without any further delays, we have our first panel that is coming up over the next 35 minutes. This is an opportunity for us to deep dive into one of the concerns that keeps everybody up at night when it comes to economies on the African continent: our sovereign debt levels. And post-pandemic, it's quite clear that these have also remained as a significant challenge, as there has been an increase in various levels of debt in sub-Saharan African economies, largely moving over the 50% level. But how is this shifting, especially given the recent updates we've seen in terms of ongoing fiscal consolidation and reforms that have been implemented in key markets? The changes as well in credit ratings and the views regarding the risk analysis of many of these economies. Coupled with that, even some of the gains that we've seen on the back of the commodity prices and how that has also translated into windfalls for government revenues in the short to medium term. That sets the context for our first panel for this morning, but of course, there's a plethora of themes that will be discussed. To help us unpack this further, I'd like to introduce the moderator of the panel, together with the panelists who will join us on stage, for what will commence as our first panel for today, reviewing the key themes regarding Africa's sovereign debt and cost sustainability. Our moderator for this conversation will be the head of Africa Region's economist for the Standard Bank Group, Mr. Gibran Qureshi, who will moderate this conversation for us, joined by several panelists: Ms. Samira Mensah, Managing Director for Research and Analytics for Africa, Head Office South Africa at S&P Global, followed by Mr. Felix Nkulugusa, the Secretary to the Treasury at the Zambian government, as well as Ms. Christina Westholm Schroeder, Senior Vice President and Chief Underwriting Officer for Sovereign Risk Insurance Limited. Those are our panelists and our first panel for today, so we are hitting the ground running, moving into first gear. I'd like to warmly welcome our panelists and the moderator up onto stage, and perhaps if we can maintain the momentum we had yesterday. Do we need a practice round, or are we still familiar? We're all familiar. On that note, ladies and gentlemen, can we please have a very warm welcome for our panelists and moderator of our first session for today, discussing African sovereign debt.
Good morning, everyone. Again, delighted to be here for the second day of the African Markets Conference. But, really excited about the formidable lineup that we have here today to discuss a very important topic. And again, covering markets for the last 14 or 15 years, I think this question about how we balance industrialization ambitions with debt sustainability in Africa has always been a key theme that we see recurring. Just some quick admin and housekeeping. We're going to be having this panel for about 45 minutes. We're going to endeavor to speak for about 35 minutes, and we're going to try and keep it interactive with 10 minutes for Q&A. But once again, as I provide the backdrop and before we go into some Q&A with our panelists, a lot of African economies have faced structural dilemmas. Obviously, infrastructure and industrialization have been essential for job creation. However, domestic savings are shallow, and external borrowing has driven up debt to GDP ratios. A key question we're going to be delving into today, and to try and find solutions, is how should African policymakers and investors think about good debt versus dangerous debt? And hopefully, we're going to try and delve deeper into the role of foreign capital, the role of domestic capital, the role of ratings and IMF programs. And I think by the end of this panel, hopefully we have answered the question whether Africa's biggest risk today, is it underinvestment or over-indebtedness? Now, Secretary to the Treasury will go into a question for you straight away. Of course, Zambia has gone through their own external debt restructuring, and congratulations to you as being the pilot who landed this plane quite safely, but you did have a front row seat in everything that was going on. And it couldn't have been easy going through this lengthy restructuring process under the G20 Common Market Framework. And for you, Secretary to the Treasury, looking back, what are the most important lessons for other African sovereigns that may face similar pressures?
So, thank you very much, and thank you very much for inviting us to this discussion. Of course, Zambia being the first country that defaulted on its debt post-COVID, and that was the first country that went through the debt restructuring under the Common Framework for Debt Treatment. It is very important that we share some of the lessons. I think there are two lessons that I can bring forward for these discussions. The first is that obviously it is a complex process. It's a complex process because in the creditor basket, there were the Paris Club that have gone through the debt restructuring before, and they have the rules, they know the process and procedures, but we had other non-Paris Club countries like China, like Saudi Arabia, like India, that were big creditors to Zambia and needed to be brought and go through this process. So one of the good side of the common framework was that it created a structure within which we can be able to discuss with these countries. And obviously looking at the capacities that we have in Zambia, in the Ministry of Finance to be able to structure such programs, we believe the common framework was better because then it brought some organization and it made sure that the capacity we had can be able to be used. The second issue that came on is that obviously the creditors would want to have a deep concessions so that they can be able to they can be able to get their money back. And in order for you to have this sustainability, obviously there is a push of how much will you be able to mobilize your own resources to be able, as they are giving you the concessions, how are you going to mobilize your own resources? And this brings a trade-off where you are now going to say, how do we mobilize resources? And in resource mobilization, you are looking at how do you rationalize your expenditures and ensure that you also have enough domestic resource mobilization. It means that you are talking about doing away with incentives for traders, for investors. It means that you have to do away with subsidies for the lower income. And obviously that then brings the political risk for the domestic stakeholders. And therefore the question of how do we balance the politics and the economies. And for Zambia, then it was culminating into a political cycle where now we are going into elections. And the question is, how do we balance this? And the lesson from there is for us to be able to say, what is it that you should be able to do to balance this? In the Zambian case, of course, we had to go for removal of subsidies. And then we identified which subsidies should we be able to remove. We had subsidies on fuel, we had subsidies on electricity, we had the subsidies on agriculture, and then we had to agree on how we align that. But what we did was, obviously when you're undertaking this restructuring, you should be able to say, how do you take care of the vulnerable? So while we're removing subsidies on electricity, on agriculture, on fuel, we then were looking at how do we assist the poor by ensuring that the social safety net is there. And we then talked about the social protection programs, the social cash transfer, where we identified the poor that needed support, and we targeted that support through the poor, obviously working with our cooperating partners. Then we talked about free education, where we are now talking about how do we break this generational poverty by giving an opportunity to every child in Zambia to go to school. And therefore, we then had an arrangement where we were removing subsidies from this electricity and fuel and taking it to education so that we support the poor as we are undertaking this process. The third lesson that we had is that we need to be transparent. And probably this is an advice that I would give to fellow African countries that will go through this process. We need to be transparency in the construction of the debt. We need to be transparency in the management of that debt. And in the transparency, we need to have some reforms that ensure that this transparency is real. We in Zambia then went and amended the Debt Management Act, and now we provided for transparency and oversight not only by the government, but by the legislative arm of the government, Parliament, that actually looks at what we are doing. We now have to go to Parliament with an annual borrowing plan when we are borrowing, and every quarter we need to publish a debt bulletin where we are talking about what did we borrow, what did we use it for, what are the terms of that borrowing, so that the stakeholders would know that we are putting the money to good use. Thank you.
Thank you, Esti. As you mentioned, data transparency is key in terms of the lessons you learned for other sovereigns. Hopefully not going to have to go through this journey, but in case they do. Christina, shifting over to you, of course, there's this big question about real risk versus perceived risk. And you're an investor who helps underwrite commercial loans that a lot of banks in Africa provide to economies. You're based in Bermuda. You are from Sweden. You're a global citizen. But how do you believe international media narratives amplify downside risks in Africa relative to other emerging markets, for example? And from your perspective, as an underwriting commercial investor loan company, how much of the risk premium reflects hard fundamentals and how much reflects perception?
Thank you. Maybe I should start with saying I'm an insurer, not an investor. But does the media, international media, are they biased on a negative bias against Africa? Yes, actually, I think they are, and there are several studies that shows that. I don't think it's only Africa. Press in general, good news doesn't sell. So good news are not reported, but bad news are. That's news. As I said, it's all over the world, not only Africa and not only sort of sovereign debt, etc. But I think Africa has a particular hard time in that it's a very complex continent, 54 very different economies. The data may not always be there, so it's very nice to hear that TS say that they are concentrating on transparency, because I think if you don't have the data, you always, at least as an underwriter, and probably an investor or a bank, assume the worst. So you always need to then, focus in on the bad news. And if you look at the studies that have been done in terms of international media, when they report on the continent, on Africa, it's what's coming up or is conflict, catastrophes, war. There's very little information in the press about the good news, that GDP is growing, that free education in Zambia, I don't think we can find that in the press. So we are constantly fed with bad news, which obviously, coming back then to your second question, in terms of a premium for a sovereign risk, for example, does that reflect real risk, or is the perceived risk involved as well? I like to think that as an underwriter, as underwriters and probably the sophisticated investors, they see through this noise. They get their news maybe from people on the ground. They have a much better understanding. It's not only what you read in the Economist or the FT or Bloomberg for that matter, but it's also what's happening on the ground. And you need to have someone on the ground, an expert on the ground that can give you that feedback. Yeah, as an underwriter, I like to think again that the premium reflects the real risk and not the perceived risk. But I need to note that obviously there's a cost of the real risk that goes into the premium, but it's not only the risk. The premium also reflects admin cost. It reflects the required return we need to be able to operate as a commercial company. And it also very much affect the availability of capacity. You have some markets here on the continent that have been very, very popular investment destinations, which means that, you know, good risks, but there's not enough capacity, which then has a impact on the premium.
Indeed. And I think as you mentioned, sadly, bad news sells, good news doesn't.
Yeah.
I recall, you know, speaking to an investor and trying to convince them not to sell a Ugandan bond because there was an Ebola outbreak in West Africa many, many years ago. Samira, shifting over to you, of course, rating agencies have been under the spotlight in the last year or so, and critics have argued that rating agencies may overweight political risk and underweight structural growth potential in many African economies. How would you respond to that critique, but also additionally, have rating methodologies evolved following the recent African debt restructuring, such as the one in Zambia, Ghana, and now Ethiopia?
No, thank you, Gibran. Yes, I think we've been in the spotlight for more than a year, to be fully transparent. So the way we don't look at political risk like in a vacuum, or it's called institutional risk, if you will, institutions. And that aspect speaks to ability of a sovereign to essentially formulate and execute on policy and reforms, and how it feeds into sustainable economic growth and inclusive growth, and fiscal public finances, so sustainable public finances. So that is the institutional assessment, and the political aspect or risk gets into that assessment in a way that to what extent essentially it could affect policy making and sustainability of public finances, right? So when you look at institutional assessment and economic risk, actually we average these two assessments to formulate and determine our risk profile on economic and institutional assessment. So it is not overweight or underweight. Both of them actually are next to each other because they feed each other, to be honest. So that is for the methodology. And you know, critics, they say what they have to say. It's their role. But these methodologies, or at least ours at S&P Global Ratings, they are public, and they are applied consistently across sovereigns, global sovereigns that we rate. We rate about 27 sovereigns in Africa, so that would be half of the continent. And Christina mentioned, you know, each economy is different. And we do have people on the ground and also outside of Africa to visit these, our sovereigns' clients. So it's important to note that on the methodology. So if you take the case of Zambia, When we are in rating committees, we essentially look at, so selective default, which was, Zambia's rating up until recently, is not a rating per se, right? When a country has defaulted, is a statement of fact. We don't call on a default ahead of time on a forward-looking basis, but our credit ratings from AAA down to B- are forward-looking ratings or statements, or opinions rather, on a sovereign's ability and willingness to pay back its debt in full and on time. So I hope you see the difference between SD and a rating. And what we have done for Zambia, we have done it also for Ghana, is that we have actually exited the selective default status ahead of time, before actually Zambia, in this instance, completed the full restructuring of its commercial debt. So what we look at is essentially the process which is under the G20 framework. They have completed actually the Eurobond negotiation to an extent that ensure there is no downside risk to go back to a state where we could have cross-default clauses that could essentially take the sovereign back to a status of selective default. So that is important, the way we move into or out of selective default. We have done it also for Ghana. So in the case of Zambia, we are at a CCC+ rating on a stable outlook. And in the case of Ghana, so the process of restructuring and the exit from default has been slightly different. Even the two countries have not stayed in selective default as long as, or let's say Ghana didn't stay as long as Zambia on a selective default path status. Sorry, and we have moved twice actually on Ghana, out of selective default at CCC+ earlier last year, 2025, and at B- on a stable outlook in November last year. So we are certainly being dynamic and proactive because we want to make sure that when a sovereign is out of the woods, we sort of can call it and inform investors, because credit ratings, they must be relevant. We are not doing this for, just the sake of it.
Thank you, Samira. I'm conscious and mindful of time. We have a few more topics to get through before we make it interactive. Esti, in light of what Samira has just mentioned, African countries such as Zambia or many others, according to you, under borrowing for development because of fear of rating downgrades and market reactions as a result of that?
So thank you. I think the first thing that I wanted to comment, and I'll be very brief, is Africa paying the perception risk. And I think it's yes. And the research has it that we are paying about 2.9% in perception risk. I'll give you an example. In infrastructure projects, in Africa, there are basically two issues that are making this risk. One is the overblown fear. Every investor believes Africa is just a monolith of a political instability and bad governance. And that's what investors think of Africa as a whole. The second issue is the data gap. Because there is no data, and we have seen that most of the investors will rely on the media. And the media obviously will talk about the negative. If I were to sit with the media house today and have an interview, they won't ask me about the success that we have had on the debt restructure, 94%. They'll ask me about the challenge that I have on 1%. And that is what is going to go into the media, and that therefore gives. And to give you a practical example, the infrastructure project default rate for Africa is 5.5%, according to research. For Asia is 11.9%. For Latin America is 14.5%. But if you ask me, what is the cost of capital in Africa compared to these countries, Africa pays higher, even if the actual risk is lower. that is one point. The second point, obviously, I agree, and this is a discussion that we have had even in the sovereign debt roundtable about what the African countries are doing, Zambia, Ghana, and other countries that are in this. And how then can this effort be recognized by the rating agents? And therefore, you look at the rating even before, given the effort and the trajectory that you are going on. Obviously, the default at that time was that as long as you are in default, the default rule was that then you will be in selective default, even if you have restructured all your debt, and you are remaining with 1%. But we are grateful now to the rating agencies that, for instance, we still have some debt that we have not yet restructured, but the rating has moved from selective default to CCC+. And we believe that this is the right way, because then it sends a signal, it gives an incentive, and we believe that we'll be able to do the right thing. Of course, some of the things, and this is the question that we ask ourselves, even as Africans, when we look at the debt, and I always say that you bankers, the accountants, they always say to every liability there must be an asset, and the balance sheet is the liability equals to the assets. And most of the times you ask, in some of the African countries, you ask yourself to say, oh, this debt that was created, there was this huge liability. Is there a corresponding asset that goes to there? And obviously that question depends on what you look for, but most times you will be able to find out that probably the assets that is being created is not equal to the liability. And this is why, for us, we believe that we should be transparent in the debt contraction, debt management. But not only transparency from the debtor countries, there should be transparency from the creditor countries also, so that we can then be able to look at these terms. And one of the challenges we have seen, even when we are negotiating, is an issue of what do we do with the confidential clauses in some of these contracts that we signed. And this is the challenge that we have. At one time, we're even discussing, is it possible that we should be able to waive the agreement that we reach? For instance, in the Zambian case, the memorandum of understanding that binds every creditor to what we are going to do, which Zambia signed with the official creditors, is not a public document. But this is the document that I use to guide the discussion that I have with the private creditors, the commercial creditors. And as we are discussing and we're talking about comparability of treatment, and you ask yourself, or the creditor comes and asks you, we understand you, but can you give us that memorandum of understanding that says is guiding you? And you say, I'm sorry, this is not a public document, it's a confidential document between me and the official creditors. And probably one of the asks that other countries, as they are coming on this lane, can we then make this information public so that everyone can be able to look at it. So we are talking about transparency and accountability, not only from the debtor country, but also from the creditors that are giving these debts to the local countries. Thank you.
Thank you, Esti. Christina, just circling back to you, investors increasingly view IMF programs as a prerequisite for lending to a lot of African sovereigns. But there have been a lot of important examples in the last 2 years. I give all our clients this example that Nigeria has done everything that the IMF would have asked them to do in the last 2-3 years without an IMF program, signaling that it's one of the more credible homegrown reform programs that we see. Do you think that IMF programs, from where you sit as an underwriter, actually reduce risk? Or do you think it's just a signal of distress or increases market stigma? How do you view it? And how important do you think the investor community or underwriting community thinks about IMF programs today?
I think IMF programs are important. I don't think they are I don't think it's absolutely necessary. We wouldn't necessarily require a country to, we would look at the country even if they don't have an IMF agreement. But when you look at the country and try to figure out whether you can get comfortable with the risk, I think an IMF agreement is one of the component of that analysis. We obviously also look at the actual figures. We look at the indicators. We look at the governance and the fiscal indicators of a country. But there again, IMF involvement gives us comfort that the numbers that we are looking at are the right numbers, and that they have been checked. We sort of expect that gives an extra comfort. We don't need to have this uncertainty that would certainly raise our concern with the country. And an IMF program also is good, and I think we spoke about that before, that the value of an IMF program is that IMF can come in and maybe provide some guidance to the country, to the MOF or the Treasury, and they can also be there and monitor progress, that the fiscal program that has been agreed is actually followed. And I think probably for most investors, they use, well, I hope they use it as one of the components, but not the only one, because it's not really a substitute for a risk analysis.
Thank you. Samira and Esti, just before we go into Q&A, we've got about 5 minutes, and I'm hoping that you both could answer 2 questions that I'll ask you in the next 5 minutes. So, Samira, first for you, what indicators, obviously we're talking about balancing industrialization with debt sustainability. So from where you sit at S&P, what indicators give you confidence that debt-financed industrialization will translate into improved credit worthiness? And Esti, of course, if there are lessons that we're talking about from the G20 Common Market Framework, of course, there also has to be lessons for a lot of African sovereigns that ended up under this debt trap on what to avoid. So do you think, because we're struggling to formalize the vast informal sector, there's been a lot of discussion about digitization, but we're still not seeing any sort of tangible evidence that this is turning around materially to drive fiscal consolidation, not just in Zambia, but I guess across many African economies. We've talked about domestic capital and how we can mobilize savings to finance our industrialization ambitions. From where you sit, how far are we from this happening to avoid falling into another debt trap, not just for Zambia, but for the African sovereigns? Samira, maybe we can start with you.
Yes, thank you, Gibran. So I suppose, it all depends on the project. If the project generates the adequate revenue to pay back the debt, then it's perfectly fine. The idea of, a public investment-driven type of growth is that it feeds into, sustainable and inclusive growth, and that this project generates sufficient revenue to pay back the debt and doesn't weigh on the fiscus. So it's not a problem in and of itself, to be honest. And if you look at African sovereigns that we rate, but also Africa in general, although it's a continent, but African economies, very few actually have buoyant private sectors that can drive growth. And so these infrastructure investments and public investments are generally, done by the government and SOEs. And so it is the nature of, the way that growth is really generated across a number of African economies. Just super quickly, conscious of time, because ST mentioned, that the credit losses on infrastructure projects indeed are lower than what could be observed elsewhere in EMs. We have actually updated our criteria methodology on MLIs, MDBs, whereby we have essentially taken into account lower credit losses for infrastructure projects and other type of CLOs, which fed and led to lower risk charges onto the way we assess capital for MDBs. So this is one way for us to look at how the market is evolving. Mm-hmm.
Thanks, Samira. Esti?
Thank you very much. Of course, the resources are always not enough, especially given the infrastructure gap that we've been talking about in Africa. And what we have done in Zambia is that apart from the government balance sheet financing, we are looking at how do we partner with the private sector into the private-public partnership model of financing. And what we have also legislated is that there's no project now that goes into the budget without a project appraisal. So every project that goes into the budget should have a project appraisal. And in the project appraisal, we are looking at, can this project be financed by the private sector? And if it has got the economic returns, and then we'll be able to look at can it be done under the PPP or any other arrangement. And only those projects that are of social returns are the ones that go onto the government balance sheet. And obviously, as they are going onto the government balance sheet, the question is, have they been appraised? Will they be able to give us? What would be the cost? And we go through all that process. Obviously, it was very difficult because initially, and this is common, I think, across Africa, that ordinarily you see that in the year of elections, that's when all projects are being done and most of them are not appraised. And at the end of the day, after the election, those projects go to waste. And when you look at some study has been done, when you look at the foregone economic returns, it is huge. How do we make sure that we protect against that? In Zambia, we have started the process, and we believe that this will be an Africa-wise process that will make sure that whatever projects we are taking on board, we should be able to look at that. But just to say one final thing is that we believe with this debt restructuring that even the creditors now will be very careful as they are lending so that they only lend to projects that will have some return and not projects that just end from nowhere. And we believe that we should be able to avoid this debt overhang as we move forward. Thank you.
Thank you, Esti. We'll now open it up to Q&A. I'm sure there'll be some roving mics going around. You could put your hand up and introduce yourself and ask the panel any question you'd like. Any questions? I see one hand over here.
Thank you very much. Maybe not a question to the panelists, maybe a question to us. When will Africa have its own credit rating agency that understands Africa? Thank you. I'm from Uganda.
Should we take a few more so we can answer them together? I see one hand right at the back.
Thank you. My name is Carl Tobejane. I work for Standard Bank. Until we are certain around our political risk, it will be difficult to even have a rating agency. But a question to Zambia. In terms of, I think the biggest weight on the political risk is the issue of, obviously, instability in our countries around Africa. In terms of the projects that we are dealing with, long-term projects that we are appraising, don't you feel that although the build time could be within the current government, the future of the projects and its proceeds depends mostly on political stability? Is that not an issue in Africa that we are seeing today?
Thank you. I think panelists, maybe Samira
Shall
and
I
Esti.
address
Sure. The first question.
The elephant in the room? Look, I've traveled across 20 countries last year, just last year. I've been at S&P for 18 years, covering the continent. So I don't know how many people can say that, and I'm Pan-African, from my first name to my surname and to my true culture. So, saying that rating agencies and people they employ don't know Africa, I think it's a shortcut. But I think ownership is good regardless. And if it takes an African credit rating agency to do so, I think it's important to allow it and that investors actually buy into it. At the end of the day, it's not for other credit rating agency to say, whether we need another one or not. It's for investors to essentially have confidence that credit ratings, generally speaking, are transparent, reliable, and produced in an independent manner. So that is really the crux of the matter when it comes to credit ratings. And global capital does need actually global standards. Global investors, they need to understand that when we have a credit rating assigned to Zambia, it is the same methodology as one that is assigned to Botswana or France or elsewhere. So that's what is required by global investors. Now, national ratings are equally important, and that speaks to the development of domestic capital markets. And I think ST mentioned, the importance of essentially tapping into private savings, African private savings. I know that AFC, the African Finance Corporation, I think estimates, total financial assets at $4 trillion. So that's a lot. So that includes sovereign wealth fund, pension funds, insurance, and banking assets. Sovereign wealth fund and pension funds are more than $1 trillion. So there is actually domestic pools of liquidity that could be tapped into through national ratings and capital markets, of course. So I think we have to be conscious of opportunities that lie ahead of us as Africans.
Thank you. Esti, you could take the second one.
So thank you very much. I totally agree with you, and this is why it is important to depoliticize the projects that we're undertaking. If we make the projects that we're undertaking in Africa political, it means they have to leave the political cycle of the party in government. But if we depoliticize them, it means they become government projects and not political party projects. And this is basically what we are doing when we're talking about appraisals, because then we'll be able to show that it is something that has gone through the government system, it is something that is going to generate the benefits, and even if there is change of government, you will be able then to demonstrate the benefits that this project will be able to bring, and therefore it will be able to sustain. But if we have got a project that is created for purposes of campaign, and the project is being financed, and then that party that started that project loses, the likelihood of the new party coming into government, cancelling that project and starting their project is too high. But at that time, you have already wasted the resources. Thank you.
Thank you. We've got about 4 minutes. Any other questions?
Hi, good morning. I'm Vib Jain with the USDFC. I was very interested in what Samira just said and what ST has also alluded to about tapping into domestic pools of capital. And I was wondering, from a policy perspective, are you seeing African countries do more to mobilize domestic pools of capital, both from institutional investors and potentially also from retail investors? Thank you.
Thanks. I think probably in the interest of time, maybe we can just take that last one. Yeah.
Thank you. I can take it now, or I will take it when I do the presentation. I will be demonstrating how Zambia is positioning itself to ensure that we mobilize domestic capital for financing of our budget. And I will be showing the trend of where we are coming from and where we are now. But the answer is that we should take responsibility as Africans. If someone is coming to help us, let them come and help us on what we are already doing or what we want to do, and not come and tell us what should be done, and therefore we abandon our own projection and go on through that projection. And when the well dries, and we have seen that the wells are drying now, that we have got this crisis.
Thank you. I think we can just leave it there, and I'll tell you why. I'm sure we can speak about this for the whole day, rightly so. But we're happy to have ST join us, and he's going to take the floor and share his vision for Zambia once we've done right after this. So we're going to have a bit more about his thoughts on all that we've discussed. But I guess from my side, my deepest gratitude to our esteemed panelists for their thoughtful insights and invaluable contribution to this very important discussion. And I'm sure that your perspectives will now help shape future public policy debate on this very critical topic. Thank you very much. I'll hand over to the MC.
So thank you very much. I will spend probably 8 to 10 minutes just to walk through the presentation that we prepared, just to share with you the Zambia story. The Zambia story starts in 2021. In 2020, Zambia was the first country to default on its debt post-COVID. And obviously, the issue that led to this were several. Among them, the severe macroeconomic instability. We saw high inflation, volatility of our currency, low foreign reserves. We saw higher expenditure that increased as a share of GDP from about 28% in 2015 to around 37% of GDP by 2021. But even when the expenditure was high, we saw that most of this money was going to debt service because the debt had accumulated so much, and very little was going to priority sectors, education, health, and agriculture as priority sectors that we had set ourselves in Zambia. And at that time, we had agreed that 20% of the budget will go to education, 15% of the budget would go to health, and 10% of the budget will go to agriculture as per the commitments that was made at the African level. And we saw these budgets reducing. Education reduced from 20% in 2015 to around 11% in 2020. Health reduced from 15% in 2015 to around 8% in 2020. And agriculture reduced from 10% in 2015 to around 2% in 2020. And therefore, you could see that basically it was making the country worse off. The debt had increased to around 129% in 2021 from around 48% of GDP in 2016. We also saw some policy inconsistencies, and as a result, production started going down. Against that, and with the new government coming in place in 2021, we then embarked on an economic transformation reform. And this economic transformation reform had two broad objectives. One, to restore macroeconomic stability, and the second one, to foster higher, more resilience, and more inclusive growth. Inclusive to make sure that we take the vulnerable on board as we are going with this growth. And the specific objective were four. The first one was to ensure that we have debt sustainability, and this debt sustainability would be achieved through debt restructuring. The second one was that we have got fiscal sustainability, and this would be achieved through fiscal adjustment. The third one is that as we are taking these reforms and undertaking these adjustments, that we needed to take care of the vulnerable, the poor, by ensuring that we increase social spending to protect the vulnerable and the poor. And the third one, the fourth one was to strengthen our governance and reduce the risk of corruption. And obviously, when I appeared before a budget committee, the question was, did we achieve these objectives? And we did achieve these objectives, and this is why we are now looking at going to the next reform agenda. The program, the economic transformation program that we set ourselves was anchored on the 8th National Development Plan. And in the 8th National Development Plan, we identified 4 sectors as the priority sector that we are going to concentrate on. And these sectors were agriculture, manufacturing, mining, and tourism. And then we identified to say, what are the enablers of these sectors? One was energy, because we set ourselves a target of 3 million metric tons of copper production over a period of 10 years. Then we needed to ensure that we increase our energy production. 2 is transport and logistics. For us to be able to undertake to transport these minerals that we are producing, we needed to have transport and logistics. And just yesterday, the colleagues were talking about the Lobito corridor as one of the strategies that we have put in the transport and logistics. The third one is technology. And again, we are talking about technology and how it can help us there. Then we had the water infrastructure and obviously the skills development. And against this economic transformation, then we say what will be the strategic supporting development areas that would be able to give us that. Human and social development to ensure that we can be able to respond to that challenge. Obviously, the 8th Secretary General of the UN yesterday was talking about the issue of globalization and climate change, and we took that as an area that we should be able to concentrate on, and governance and as one of the areas. And if I were just to give you an example of the governance area, in the governance area, we actually had corruption measured as on the perception index, improving from about 33 in 2021 to around 39 in 2025, and we believe that we'll continue improving on that. And then, obviously, then the question was, if we're undertaking this economic transformation reforms, what are these reforms that we are going to undertake? On the economic front, we talked about fiscal consolidation, and in the fiscal consolidation, we talked about expenditure rationalization, enhancing domestic resource mobilization, and limiting external borrowing, and only external borrowing gotten on concessional terms. What this meant was that if our domestic resource mobilization is, say, 25% of GDP, and we are having an expenditure of 37%, what that means is that the difference should come either as a loan or as a grant from cooperating partners. But once we rationalize and we reduce from 37% and we bring it, say, to 28%, and our domestic resources is 25%, it means that our borrowing then reduces to the difference of that. That is basically what it means. And therefore, we needed to look at both sides. On the revenue side, how do we increase? On the expenditure side, how do we rationalize and make sure that we prioritize? We then had to ensure that in order to bring everyone on board in an inclusive growth model, how do we therefore have rationalized and well-targeted subsidies that are going to be able to have impact? And we had the social cash transfer, we had the free education, we had the health reforms, we have the Consumer's Development Fund, where now we are talking about taking money to the local or to areas through the Consumer's Development Fund model, while we are looking at devolution as the outlet that we are going to embark on, so that the local authorities are the one that will be able to be in charge on this. We then found a lot of challenges. Zambia is dependent on the mining sector. And the question was, what do we do in the mining so that it can continue anchoring as we are looking at the diversification? We had some companies that were just about to pull out. We had 2 big mining companies, Kokola Copper Mine and Mopani Copper Mine, that had stopped mining, and some Kokola Copper Mine was in court, and Mopani Copper Mine was actually abandoned. And we engaged with the investors And as we speak now, both Konkola Copper Mine and Moponi Copper Mine is on board, and our copper production has started increasing. We are targeting to reach 3 million tons in the next 10 years. We now are around 933,000 metric tons. This is the first time we have reached those levels. We have always produced around 750,000 metric tons, and we believe that in 2026, we'll be able to reach 1 million metric tons, and we'll be on course to go towards our 3 million metric tons. Obviously, we then embarked on the debt restructuring under the G20 Common Framework, and the G20 Common Framework then says, okay, you go and have this debt restructuring, but it should be anchored on an IMF reform program. And the IMF reform program basically was to give some surety to the creditors that are coming on the table that Zambia will be doing the right thing. It was easier for us because that IMF reform program was predicated on the 8th National Development Plan. So we went to the IMF and we told us, this is our plan, this is how we want to implement it, and the IMF then agreed and said the plan is good and we are going to support it. So implementation was not difficult because this is a homegrown program that was being supported by the IMF. What are some of the reforms that we committed to undertake? One are the debt reforms, the legal framework where we now have provided oversight by Parliament to see what the executive are doing, where now we are talking about having a debt management office, modern debt management office, front office, middle and back office that will be able to make sure that we have got good construction and management systems in place. We then talked about amending the law that now makes it mandatory for us to be able to go to Parliament on a quarterly basis to tell the Zambian people and the stakeholders what exactly we are borrowing, for what we are borrowing, and what are the terms on which we are borrowing. We then had also other reforms that I already talked about. In the agriculture, we had direct input support where government was buying inputs and giving to deserving farmers. We then moved from there. We had proper targeting, and we came with what we call the e-voucher system, where we identified the needs and gave the money, a card to the farmer, and the farmer was free to go and get whatever input that they needed to get in order to be able. And then we also made sure that we cleaned up this system. The first year of doing this system, we had 1 million farmers on the system, and 280,000 of them we found they were ghost farmers. They were not existent, but they were getting this, and we believe that we are going in the right direction. And because of this support we are giving, in 2025, we had the highest maize production, 90% of which came from the small-scale farmers, most of them that we are supporting on this FISIP. And we had that biggest bumper harvest. In 2026, with the rains that we have, we believe that we are even going to have the higher production than we had in 2025. And now we then look at what have we achieved during this period that we have taken these reforms. 2.1% average growth in GDP over the previous 5 years compared to 5.2% average growth. When you look at the inflation, we saw that inflation was going up, and now it is coming back to the single digit, to the band of 6 to 8%, which is our target inflation. And we saw that in the first quarter of 2026, we'll be able to achieve that, and we believe that will be sustainable on that level. On the right side, you see the graph on international reserves. At the time in 2021, if you look at July 2021, our international reserves were about 1.4 billion, or just under 2 months of import cover. We have now increased our reserves to about 5.5 billion, and we are at about 4.8 months of import cover. When you look at our exchange rate, we had exchange rate that was broadly on depreciation since 2021. However, we have seen that exchange rate now has stabilized, and in the last month, in January, it became strong, and other people or other media houses were reporting it as the strongest performing currency, and we have seen that we are achieving that. This basically is showing about the budget discipline that we have introduced, and here we are just comparing what was the fiscal deficit or the debt financing of the budget compared to the economic growth. And when I was doing economic development at my college, my professor said that sometimes correlation does not mean causality, but when we see in this graph, we see a lot of correlation, and one would say probably one causes the other, and where we see that when we are borrowing more, our growth was low. When we reduce our borrowing to finance the budget, our growth is going high. There are other countries now that have even introduced fiscal rules. Indonesia is one of them, where they have introduced fiscal rules. By rule of the thumb, we are told that when a poor country borrows more than 3% of GDP to finance the budget, that country will have challenges in servicing that debt. And our fiscal policy now is that our budget deficit should not be more than 3% of GDP. And this is what we are doing. This is the question that was asked: how are we making sure that we cushion ourselves to a debt default again? On the left slide, we are basically showing what is our domestic revenues as a share of GDP. And on the right side, we are showing ourselves what is our domestic revenues as a share of the budget. In 2021, 59% was the domestic revenues. It means that the rest of the money was borrowed or it was through grants. By 2025, we reached 81. In 2026, we are saying that the budget will be financed, 82% of the budget will be financed by the domestic revenues, and we are projecting that to go to 87% in the medium term. The next graph is basically showing on our debt restructuring and sustainability. Remember, I showed you the graph that was dipping in terms of what we are borrowing, and obviously, with the debt restructuring, our debt now, that was raising up to 1.9% of GDP, is now reducing, and in 2025, December, this debt was at 94% of GDP, and therefore we are creating fiscal space and reducing the borrowing. I'm just remaining with one slide, if you allow me. This is the slide that basically I was talking about on the credit rating, and it shows. And now the question is, where do we want to go? And these are the macroeconomic objectives we have. Our growth in 2026, we project it at 6.4%. Inflation, we think, will be within the band, and that we have our domestic resource mobilization effort continuing. And this graph is basically showing where Zambia is being positioned in the medium term from 2026 to 2028 compared to Sub-Saharan Africa country. And you see that our performance in terms of economic growth on average is higher than the Sub-Saharan Africa country. And the last table that I had was basically what is it in the debt restructuring. Where are we now? We have finished our program with the IMF, successfully completed all the 6 reviews. We now are going into the new program with the IMF. The mission team of the IMF will be arriving in Zambia tomorrow for us to start looking at the scoping mission of what the new program should look like. And our view is that we'll continue on sustaining macroeconomic, preserving fiscal discipline, but now talking about creating conducive environment for private sector investment and job creation. Let me end here and say thank you very much all, and it's a pleasure once again to be with you and to present the Zambian story to all of you. Thank you.
So World to Africa is a research initiative by the global research firm Value Exchange. And the objective of the research was to reach out portfolio investors globally to assess their sentiments towards investing in Africa. Standard Bank decided to sponsor the whole initiative. Being the preeminent bank in the region, we partnered with a number of global institutions like Bank of New York and other industry associations to make sure that its survey can reach to as many investors as possible. So we plan to use that feedback for two purposes. One, to demystify Africa for the investors. And second, to use that feedback to work with the regulators and the market infrastructure in the region to make those changes which makes it easy for the investors to come to the region. What we have seen in the latest World to Africa survey is clear. Investor appetite for Africa continues to strengthen. Over 50% expect their volumes to grow in the next 2 years, reflecting the rising confidence in the region. And what's fascinating is that 27% of the global investors admit that they are still underweight in Africa. And that's approximately $4 billion, which is ready to flow in the next 12 to 24 months. And this interest is particularly concentrated in South Africa, Ghana, Kenya, and Zambia. Sector-wise, investors are leaning strongly into digital infrastructure, banking, fintech, and climate-linked sectors, with digital infrastructure alone driving interest for 40% of the global Africa-bound investments. Combined with rising sustainability allocations, especially from Europe, Africa's investment appeal is becoming broader and deeper. So, despite the strong interest, the investment flows real friction. 64% of the investors say that Africa allocations are being limited. And the majority cite the same pain points: FX issues, settlement processes, and asset servicing challenges. FX being the biggest single blocker. Investors can get money in, but 50% of the people are saying getting funds out is a real problem due to liquidity shortages, restrictions, although this has improved in the last 1 year or so. On top of this, operational friction is rising. Up to 70% of the investors report that manual processes, inconsistent documentation, and infrastructure gaps are capping their volumes. The message is clear from the investors. They want to deploy more capital into Africa, but the cost and complexity of navigation, the market infrastructure, that slows their ability to scale. So commercial bank plays a critical role in unlocking the investment potential. There are 4 areas where bank can support investors. First, we can give investors far better tools to manage FX risk, improve liquidity access, and navigate repatriation more confidently. Second, simplify the operating environment, reduce settlement friction through automated platforms and real-time transparency. Third, offering deeper local insight from sustainability data to counterparty risk to help investors make informed decisions. For example, Standard Bank is working on a data-driven sub-sovereign risk assessment tool that would become available to investors pretty soon. And finally, by supporting repo markets where we can help strengthen the liquidity across the region. Ultimately, banks' job is to act as a trusted navigators across 54 different regulatory environments and to de-risk the journey for investors in Africa. The appetite for Africa is real and growing. By strengthening market infrastructure, improving FX regime, partnering more closely with regulators and the banks, we can convert Africa's potential into sustained, scalable global investment flows.
It can have a little bit more energy than that, just to acknowledge the growth and support. Thank you. And I think really important that we reflect on many of the conversations that we've heard so far this morning, giving us some perspective around the robust levels of growth, interventions, and reforms that have been implemented. Of course, the interesting perspective in terms of how credit and risk needs to be reassessed when it comes to the continent, but more importantly so that the on-the-boots and on-the-ground initiatives are present to make sure that there are partnerships that are aligned to provide clarity, context, and data. Can more be done? Certainly. Through collaborative efforts and enhanced transparency, that's much of the growth that we're looking forward to. On the back of the Vision for Zambia presentation, I do want to remind you that after lunch, there will be several breakaway sessions that will run concurrently, where we will be able to deep dive further into some of the investment analysis and the visions for the various countries that are represented at the conference. So if you enjoyed what you heard over the course of the 2 days, do bear in mind that there will be an opportunity to deep dive further into some of those key themes with different country representatives in the breakaway sessions. But we're moving gears now to another key theme and conversation that has garnered a great amount of attention. For many of you here in the room, and even as I observed much of our behavior, we all have one particular device in our hands, probably all the time: our cell phones. You're more likely to forget your car keys at home than you would your cell phone, is the culture and the livelihood with which we actually live our lives these days. And this gives us some context as to how that has also influenced and penetrated our financial behavior. We've moved away from, yes, having the structures that we have when it comes to our relationship with our banks. Banks themselves have become a lot more innovative in engaging and tapping into the use of technology. We've seen the growth of mobile money, but now it's all about fintechs and finding some innovative ways of partnership and, of course, the shifts in regulation to see the regulation of movement of payment in particular when it comes to banked and non-banking players. That speaks to a big opportunity that not only speaks to investment potential that we can tap into, but also what observations we need to be mindful of regarding the support that this sector and industry needs. This panel discussion, or rather fireside conversation, is one that will last for about 12 minutes, will be very refreshing and enlightening in terms of the opportunity that does exist. And we're using one particular case study being a company called OPay, a fintech company that itself has seen an opening up and expansion of its license operation, particularly in Nigeria, but of course has also seen leadership changes with a new co-CEO coming on board to help amplify its strategy, of course execute on the growth that they need, and we're going to understand how they do this, not only in a market like Nigeria, but opportunities that they grasp across sub-Saharan Africa in partnership with Standard Bank CIB. I'd like to welcome to the front of the stage the moderator for this conversation who will be leading us in discussion, and of course the guest who will be giving us some insight into all things revolving the future of money. AI payment-driven ecosystems. This conversation will be moderated by Mr. Thabo Makoko, Head of Transaction Banking at CIB at Standard Bank Group, and of course Mr. Lars Boyleson, who is the Co-Chief Executive Officer of OPay, to give us some perspective around the view, the outcomes, and of course the new strategy that he looks to implement following his recent appointment at the company. Please warmly welcome to the front of the stage Mr. Thabo Makoko and Mr. Lars Boyleson.
Oh, thank you, Kuku. I think stunning introduction. Appreciate it. Good morning, ladies and gentlemen, and all protocols duly observed. Welcome to the conversation on the future of money and AI-driven payment ecosystems. Trevor on Sunday, for those that were here, spoke about the limitations of AI in the arts. But there are some interesting use cases developing over the continent that I think will change how we live. I mean, we're living in a world now where, you know, your fridge would be able to make better grocery pricing decisions than you, or your car applying for better insurance policies than you. And AI is also rewriting the definition of payments in many of the parts that we see it. And as Kukuletu has said, today I'm joined by OPay, that is building that future. And OPay has digitized the Nigerian consumer faster than some countries have digitized their tax payment systems and with far fewer complaints. It's going to be interesting for the two of us to talk with this flower in between us. But yeah, look, let's just drive straight in. Lars, thank you. Thank you for being here. And as I mentioned, OPay has scaled the payments world, wallets, micro-lending, and many other key things at a pace many could not actually match, particularly in the economy that you're playing in. What do you see as the next scale innovation that OPay is working through that will make things possible using AI in Nigeria that were not possible before?
Yes, I think so thanks for the kind words, and I think the main reason for our crazy success in Nigeria is actually due to the fact that our platform was built for massive scale. We made it AI-enabled from very beginning, and the best example is probably when there was the currency crisis in Nigeria, where there was a lack of cash beginning of 23. Millions of Nigerians went on fintech platforms, which was available in the market at that time, and that was the time where the OPay platform was the only real scalable platform with high trust, and that has continued till today, where we have 38 million users visiting our digital bank on a monthly basis. We have more than 1 billion GTVs transactions per day. And in fact, it's actually the second most used app in Nigeria. So think about a banking app in Nigeria which is more popular than social media, browsers, etc. That's not bad. So it's been amazing. So answering your question, how can we use AI to take growth to the next level? I don't think that will be about a single AI model. This will be more as, in OPay, we think more about this as a real-time trust fabric. Using AI to get to the next level in growth, we need to make trust, of course, the most important factor, but also make trust cheaper, faster, more precise as transactions volume will grow. And this means that we will move from isolating risk scores to a more multi-layer risk fabric, where we will have sources from many places in the network in the app. It can be from identity, confidence, it can be behavioral risk, it can be from risky signals in the network. Many different sources will come in, and we'll all channel this into AI-enabled decision engines, which of course will be high standard, very trustworthy, and they will also be regulator safe and have and be explainable, and of course have deterministics fallbacks. And I think the key thing people are always talking about is, of course, fraud, which is a very important trust factor here. That is very interesting what we can do with growth and with AI. So it probably will make us able to move fraud management from post-event detection, which is what we have today, to the future being basically preemptive prevention. So AI will allow us to basically model intent on the platform in the network. So by modeling AI fraud intent in the network, we will be able to, and we can do that by actually getting signals from the device, from the network. We will be able to stop fraud rings before losses actually materializes, instead of looking at post-event individual transactions. So you know, AI is going to be really important in the next level growth, and it will secure further growth, making sure that banking will be available to everyone who doesn't have access to banking today, and we will be able to do that in a very trustworthy, less risk way. So excited about AI and how it impacts.
No, wonderful. Thank you, Lars. Just curious, I mean, wallets we're starting to see, you mentioned a lot about wallets are becoming more and more like super apps. I'm just curious, what partnerships or infrastructure shifts are required to get us there?
Yeah, so that is one of the, that's why we do this in step by step, and that's why many of our, we're still using, you know, individual risk scorings. We're not there yet. We are heavily investing into our network. Latency, low latency in the network is extremely important before you implement these AI models. So heavy investment into AI modeling, meaning taking advantage of, you know, new features like AI inferencing, which is some powerful hardware that makes sure that the speed of the network is extremely high. And we know here on this continent that we have incredible peaks in the network. We have downtime as well. So we cannot have glitches in terms of trust and latency in the network. So massive investments going into that. Yeah, so that's the requirement.
I didn't hear anything about partnerships. I appreciate that infrastructure question, but partnerships?
Yeah, okay, on the partnerships, and I think so as a provider of banking service, we are of course focusing on trust because this is the most important thing for our users. But I think what AI also will change is of course partnership, as you mentioned, but the whole consumer experience will be lifted due to AI, right? Today we have many interesting services, but it's kind of basic service, banking service, which has gone digital. By fully empowering AI on our platform, we will make onboarding much easier, which is great for people on this continent in Nigeria who does not have access to banking yet. So that will be frictionless by using AI. Verification will be in the background easier. And then second, the whole platform, the whole banking experience, consumer experience will go from being, today it's very request-based from the consumer. By using AI, we will move to a much more, let's say, needs behavior request. So we will simply serve the needs of the consumer based on their profiles, on how we, on what they need, and so we'll be much more predicting services than instead of waiting for requests. And we will also be able to provide much more partnership into the wallet. Today, we do have fully immersion enablement today, but we will be able to bring more service partners into the app, which can be anything, you know, taxi, food delivery, all these kind of things we have in there, but we will have a full spectrum. And it will go beyond banking in our app very soon. We see this from leading market outside Africa that it's, you know, digital banks, wallets are beyond banking today, and that will happen here in Africa very soon as well.
Thank you. One bet that you're willing to take that how AI will transform the payment landscape by, let's say, 2030?
I think 2030.
2030.
Yes.
Yeah.
Okay. Yeah, I think we think we will have maybe more than 100 million on our platform on a monthly basis. We will have all daily things you need will be served in the app. It will be all the basic banking apps, but there will be, but you will have a full catalog of service you need for your daily life, and we will, the whole unbanked population, we will help them to onboard, and AI is going to be a very important factor in that process. So more than, I think the population of Nigeria, you will see up to 80% can have a banking account.
Excellent. Thank you, Lars. I think what's clear is that the future of money will not be led by banks alone, or fintechs alone, or by infrastructure suppliers alone, but the intersection of all three, accelerated by AI. I think I've been very pleased to be with you today, and as Mo Ibrahim once said, Africa skipped landlines into mobile. I do believe that Africa will also skip traditional financial rails into a little bit more of AI native money. So thank you very much.
I agree. Digital banks, like we see with OPay in India, and particularly here in Nigeria, you will see it will impact lives in a completely different way we have seen in the Western world. Here you will see people accessing banking wallets and accessing needs in the daily life which are beyond banking.
Excellent. No, thank you very much. Thank you, Lars.
Thank you.
Gentlemen, giving us some perspective around the growth opportunities that certainly exist there. Usage of technology and apps, an ongoing theme that will be discussed further. While we continue with the momentum, and this time would like to get some perspective on what's happening in an economy that has often faced many questions, opportunities, but of course, ongoing partnership. To give us some clarity and perspective around the follow-up and the process following a change in their currency, being backed by gold, and the introduction of the Zimbabwe ZiG. Also taking a look at how they've managed the dynamics regarding monetary policy against inflation and growth that we do see in that market. We'd like to welcome to the front of the stage to give us some insight into the vision for Zimbabwe being in focus today, the Deputy Governor of the Reserve Bank of Zimbabwe, Dr. Innocent Mache. A warm welcome to him, please.
Good morning, ladies and gentlemen. Okay. So first of all, I want to thank Standard Bank for inviting us to this year's conference, and for taking the difficult decision to give us a session to update you on the Zimbabwean case. Firstly, I would like to say that for the last few years, we used to have meetings within our CCBG, and when you think about our macro economic frameworks and the convergence criteria, Zimbabwe was always left on the side. Why? Because it was a special case. I would like to say this morning that that is no longer the case. How so is what I'm going to try and update you on. Firstly, I would like to talk about very briefly about the growth perspectives. So in 2005, we had estimated that Zimbabwe will grow by 6.6%. But that has been shown to be an underestimate. We are now expecting growth to be 8% plus. This outperforms all of the numbers that you have seen on growth this morning. But the most important thing is the next graph. I hope it's clear enough to give you a summary of the macro achievements to date. Firstly, on annual inflation, which is about 4.1%, and month-on-month for the past 12 months, 12 to 18 months has been around 0.2%. Month on month, in terms of growth of M3, keep your mind on M3 because I'm going to say something about it given our monetary policy framework to date. Of course, we launched the Zimbabwe Gold, the ZiG currency, in April 2004, and we have seen it stabilizing in a band of plus or minus 26%, 26 or so percent, 26 or so Zimbabwe gold to the US dollar. In terms of total reserves covering the local currency, it's now about 1.2 billion. That's just the local currency, by the way. I will say something about that a little bit later. Our non-performing loans for the banking sector is about 3.07%. Last year, it ticked up a little bit to 3.47%. Foreign currency reserve cover is about 6 times the level of money in circulation, and lending has been maintained at a zero to the Treasury. Here, I want to just draw your attention to a few indicators. Basically, I want to draw your attention to the last implied exchange rate. If you look at that, you will find that there is a very consistent slide towards the level at which the ZiG was launched. When we launched the currency, it was about 13.76 to the US dollar. The implied exchange rate is at 14. And you can derive that from the money in circulation and the reserves that we have. Because it's a reserve-backed currency, that's easy to calculate. In terms of the local component of reserve money. Okay, let me now tell you why I keep talking about reserve money. The monetary policy framework that we are on in this period of transition is based on 2 things. We use reserve money as an operational target, and the exchange rate as the intermediate target. That's why the anchor, the monetary anchor, will be the exchange rate. So that's why I keep drawing your attention to M3. Now, I think this talks to the month-on-month growth of M3, but I want to stop here where we talk about the amount, the sustained foreign currency surplus that we see in the economy. Foreign currency payment in Zimbabwe have consistently be below the revenues that the economy is generating. And most of those revenues, although we've got a small component of remittances and such, the largest component is from manufacturing. Now, in terms of foreign currency receipts, the resilience of the foreign currency generating capacity of the country is soon a notable increase of about 21.8%. And what you see there is a consistent level of the export proceeds coming through. As you can expect, loan proceeds are very small for Zimbabwe, and therefore we think that at 59.7% of the total foreign currency that's being generated, we're on the right trajectory, because that's actually the economy performing. In terms of other metrics, particularly to do with the breakdown of those foreign currency receipts, gold is topping the list with a share of 45.3%, and platinum at 16.7%. And of course, the agricultural sector, we have tobacco at 16%. I want to draw your attention to ferrochromes. In terms of ferrochrome exports, there has been, in the last few years, a huge investment of about slightly over $1 billion in iron and steel works that produces iron and steel not only for Zimbabwe, but for the region as a whole. Here, we may be taking advantage of Mittal not doing so well, so we hope that things will improve for them. But in the meanwhile, the trends in foreign currency reserves, import cover, indicate that we consistently have not only a trade surplus, but also a current account surplus, with total exports showing a resilient rise and maintained above the imports that we have. In terms of the backing of the currency, as you can see on the green line, we cover about 6 times the ZIG deposits that we have. So as monetary authorities, we are happy. In terms of foreign exchange dynamics, as you can see, it's very consistent, and the premium has consistently been narrowing. Now, in terms of inflation, I think the dynamics talk to themselves. Around June, as I said earlier, we started noticing a big drop in inflationary pressures, and therefore we are now in single-digit inflation at 4.1% year on year. Now, let me quickly talk about a move towards monocurrency, because some in the room might be worried about what it is that will determine when we transition to monocurrency. One of the biggest indicators for us will be whether or not we can sustain the trajectory, and whether or not that trajectory is backed by real assets. We believe that opportunities abound in DPI. We believe that opportunities abound in mining and manufacturing, where we have a huge comparative advantage. But I would like to draw your attention to where money has been flowing, which is in gold, lithium, and in ferrochromes. However, agriculture is showing huge upward movements, and therefore we believe that agriculture, particularly blueberries and tobacco, are doing extremely well. So there are huge investment opportunities in those areas. Let me end by saying what is different. I wanted to begin by saying, if you heard the Ghana presentation, you heard my presentation. So you can see I am talking about something that's slightly different, but if you cast your mind back to Ghana, that's exactly where we are. But talking about the last area that I would like to draw your attention to, tourism. There are huge opportunities and huge incentives for tourism. As you know, the sector that is expanding faster than all other sectors in Zimbabwe right now is tourism. So, and these incentives are across the whole tourism value chain. Lastly, I said what is different. Just quick 4 points, Madam. Let me quickly give you the 4 points that is different this time around. Historically, most of the upheaval in the Zimbabwean economy were centered around money supply. Now, as I said earlier, our currency is now fully backed. So there is nothing that will cause that upward tick. And we will maintain the trajectory as the reserves grow. We have just agreed on a staff monitored program, but I want to indicate that all prior actions and the benchmarks that we have agreed are not onerous, and we have basically met those even before the program began. In terms of how we view the SMP, we view it as being a validation of what we have been doing and what we are doing. Then the third is that the 8% growth has been achieved without this program. Zimbabwe receives very little external financing. And so far, we've managed to sustain all of the metrics that I gave you without that financing. Lastly,
yes.
There is a close coherence between monetary and fiscal authorities. We hold cash management and liquidity management committees between Treasury and the Reserve Bank every fortnight.
Fantastic.
And there is zero monetization of the government deficit. So thank you very much.
Thank you so much, Deputy Governor. Much appreciated and appreciate the insight. A gentle reminder that there will be an opportunity to engage with the various company representatives to actually hear more about the visions, the investment potential of the countries that they have to expand, or country representatives that will be able to share some perspective and feedback with you. But we keep the momentum going, and as we prepare for us to actually understand the lay of the landscape and even prepare for our next panel discussion, which we'd head into in just a moment, perhaps it's also important that we reflect on some critical investments that have been taking place across the continent, especially when it comes to innovation, supported by financial services, AI, and the growth that we see within that potential. So let's take a look and pay attention to the screens regarding growth opportunities that we see. Following that, I'll introduce our next panel discussion, which will then lead us to our first tea and comfort break for the day. So we're building the momentum, right? You can tell we're covering a myriad of topics and themes to make sure that we all get a better understanding of where the growth opportunities lie and the partnerships. I do want us to cast our minds back very briefly to the pandemic. You might recall the blockages in the Suez Canal, closures to our borders, nothing was moving, and whether it was toilet paper, medical health care, and health and pharma supplies, or maybe just an order that you might have put through on your normal or regular online retail platform, you might have recognized that there might have been blockages in the system. And that speaks to the importance of supply chain and logistics. On the back of the theme that the Africa Free Trade Continental Area Act is a key enabler and propeller for growth on the continent, how do we ensure that, pandemic or not, blockages at our ports or not, we unlock the full potential of this trade agreement? That sets the tone for our next panel discussion. We'll be hearing from financiers and players within the logistics environment to give us some context to fully unpack how best we expand on this. There will be a Q&A which is also allotted to this particular panel discussion, so we will encourage you to boldly share your questions. And this conversation will be moderated by Head of Client Coverage for Standard Bank CIB, Mr. Crosby Mkwanazi. He'll be joined by several panelists who will be on stage with him today. Mr. Cyril Bitanda, Head of Trade, Finance and Correspondent Banking at African Bank. Mr. Colin Emmanuel, Chief Executive Officer at C. Steinweg Bridge Group. Ms. Fatima Sullivan, Regional Vice President for Southern and East Africa at DHL International. And Mr. Gabriel Swanepoel, who's the Senior Vice President, Country Manager for MasterCard Southern Africa. Please give them a warm round of applause, as these are people who keep movement in the economy going.
Good morning to this exciting forum for this morning on intra-Africa trade and capital flows. It's a longer title, but I won't go through all of it. This session today was actually well teed up yesterday when we were challenged on why so much of a focus on mobilizing capital as opposed to mobilizing trade within Africa as a growth engine. So we're going to be discussing trade in that context today, and hopefully we can answer the other side of the growth engine, which is trade, over and above what we've spoken about in terms of mobilizing capital. But before I start, I also just want to put another context, which is we all know that intra-Africa trade at the moment hovers around 15% as a regional trade area, and the average globally is about 40%. And of course, we saw a slide yesterday on Asia. The fact Asia's already reached about 60% regional trade as an area. So there's a massive gap between where Africa is at 15% versus where Asia is now at about 60%. However, there are other markets that have chosen to drive economic growth through trade with bilateral partners that have given them the growth that they require and don't necessarily subscribe to the argument that your best trade partner is your neighbor. So just putting it to the panel, and I can start with Cyril at the end. What is your view around what is more important? Is the objective for Africa that we drive trade and grow trade as a growth driver for the continent, or is it mostly to focus on intra-Africa trade and the benefits between the two?
Well, thank you. Thank you very much, Crosby. First of all, appreciate for inviting Afrexim Bank to participate. And we, I think, believe both trade within Africa, which we term as intra-African trade at the bank, and extra-African trade are necessary. The continent, as it stands, remains a net importer, more or less. A few countries that are not in that position on the continent, about 2 or 3. Therefore, trade with the rest of the world remains very key. But then we are intentionally, at least from the Afrexim Bank point of view, we're intentionally working on the process of growing internal intra-African value chains. We are carrying out a process of remapping the trade routes on the continent. Unfortunately, most of the trade routes that we have were prescribed to us by, I know I come from East Africa, and the rail line we have was inherited. We inherited it from the builders who are coolies, who came for certain reasons, and you have this rail line going to different points in my country, in Uganda, for example. It goes somewhere where we are getting copper, and that copper was going somewhere, all right? So we are reworking the trade routes across the continent, together with a few, what we call intra-African trade champions at the bank. Of course, we know Dangote, that are intentional about this. And therefore, we hope that with time, if we give it time and we remain deliberate and collaborate together with financial institutions, with central banks, with governments, I think we'll shape and grow and grow the trade, the intra-African trade, but also reduce the trade finance gap on the continent. So for me, or for us as a Afrexim Bank, the two are necessary. And I'll probably have an opportunity to give more details on what some of the actions that we've taken since we launched the intra-African trade. First of all, department. Some of you must have participated in the intra-African trade fair. We hosted it here in Durban 6 years ago. Last year it was in Algeria, and next year it will be in Nigeria. And so many other things that we're doing to make sure that we allow Africans and the rest of the world to know the capabilities that are within the continent, and therefore, they get to know where they can source some of these goods and services that they require, which are available on the continent.
Excellent.
Thank you.
Thank you. So Cyril's going to sit on the fence on that one. Fatima, what's your views?
I'm going to join him on the fence. So really my view is that Africa's integration has a number of challenges, and these are significantly different to some of the countries you referenced earlier on, i.e. Brazil, India, etc. My belief, or our belief at DHL, is that we need trade negotiations to be taken from an African standpoint, for Africa, by Africans. Okay? And what that means is that ultimately a combined approach is in fact the necessary approach for the future of Africa. Neither trade approach, intra-African or global, is inherently better than the other. What they do have is they have fundamental benefits that can be offered if used effectively. DHL's approach is very similar to that of Afrexim, and in fact we're partners in some of the intra-Africa trade initiatives taking place. We certainly believe that the fundamental base and starting point has to be intra-Africa trade, because that will build the industrial capacity on the continent, and then you can bolster that with external trade, which will then deliver scale, technological access, etc. I think the main thing, and just to throw some numbers out there to whet the appetite, you referenced that intra-Africa trade is hovering around 14-15%, and Asia is around 60%. If you take intra-Africa trade in 2024, it was estimated to be around $220 billion, which represented a 12.4% growth year on year. Now that's a phenomenal achievement, right? But context is important, because that's only 14 to 15%. If you look at AFTA, what they have indicated is that the opportunity that we face in Africa is an income opportunity of $450 billion. And that's where we need to focus. So, yep, on the fence with Cyril.
Excellent, but highlighted a number of reasons why intra-Africa trade, I think, is important. Colin, that fence is going to fall over if you stay on it. What's your thoughts?
Yeah, I mean, it's an interesting topic. You know, we are in the logistics business, and we move commodities out of the continent, and we move finished goods into the continent. So, you know, our challenge is to try and balance those that logistics flow. And for many, many years, the continent has been an exporter of unbeneficiated commodities and an importer of microwave ovens and kettles. And that has to change. And certainly in the last 3 years, we've seen some of that change, which is quite exciting for us. The Deputy Governor of Reserve Bank of Zimbabwe was talking about steel manufacture in Zimbabwe. In my time, 35 years in this business and traveling around the sub-region, we found that very exciting, and we didn't believe that South Africa would be importing semi-finished steel from Zimbabwe. I think that's a great achievement. We're seeing green shoots in southern Mozambique. We are importing pipes. Lithium battery factory going up in Ndola in Zambia, where Zambia has been a net exporter of cobalt, out of the DRC, net exporter of cobalt, but we're seeing lithium batteries being produced, and copper rod. You know, we've exported copper cathode, raw material. Now we're producing copper rod in Zambia. So we are seeing some of that manufacturing, that production, and that being traded with our brothers and sisters on the subcontinent. So I think that's quite exciting.
Excellent, thank you. Do you want to round us up, please?
Yes, thank you. Thank you, Crosby, for the opportunity to be here today. Really appreciate that. I think listening to Fatima speak, I think I echo that sentiment. I think the from an intra-Africa perspective, with the trade flows in Africa constituting roughly 15%, we have a long way to go. Fatima highlighted the Asia number at 60%. We know Europe is sitting at 70%. But there are structural things that we need to ask ourselves. So why aren't we seeing the same amount of trade that we see in markets like Brazil or India, for example? And I think that we need to recognize some of the structural realities that we are faced with on the continent. One of those structural realities is that we operate in 54 markets across the continent. And those 54 markets come with its own regulatory obligations. It comes with its own localization rules. It is 54 markets that operate across 42 different currencies. So the complexity around FX is much more involved than it would be in some of the other markets globally. And so then I think that, from a MasterCard point of view, we ask ourselves, how do we bring that together in a way that, creates a more cohesive operating environment? And how do we deal with some of those structural issues? And we think that it can be unpacked around 4 very distinct areas. I think the first areas is that we need to think about instant settlement. So we need to speed up the rate of flow and value exchange, and we need to do so across the rails. I think there needs to be a recognition also, secondly, that the cost of remittances into Africa is just far beyond what it should be. The UN benchmark, the SDG of the UN, sets that benchmark at around 3%. Africa's way above that number. And we need to work around that. I think, also to Fatima's point, there's a very real structural issue around logistics, the way that we think about the infrastructure creation around logistics. And I think that the last thing to point out is access, which we can talk about a little bit later. And it's access not just in terms of, access to markets, but it's the ability for, the smaller micro enterprises across the continent to actually access more formalized markets and thereby participate in the flows. And I think that there's a large amount of anonymity that is excluded from the numbers that we're looking at today because we don't have a recognition of where those flows come from.
Excellent, thank you so much. Maybe let's just turn this into the opportunity. So we've covered the why, we think trade is important and the role that it plays. And maybe Colin, if I just start with you, what do you think the biggest opportunity in your industry that you see that if we improve or able to make a breakthrough in certain areas, we could see a transformative growth? What excites you? What do you think the biggest opportunities are?
Yeah, I think it's an awesome time to be an African. All the two superpowers want to court us. They want our raw materials. We've got infrastructure gaps in the sub-region. From a logistics point of view, we spend most of our time. We wake up early in the morning thinking about how we can bridge those infrastructure gaps to ensure that we ensure route to market for our customers, how we can balance the exports with the imports, how we can de-bottleneck some of the corridors, and we run on all 8 different corridors feeding in and out of the sub-region, and that's a wonderful opportunity for our business, and I think it's a wonderful opportunity for Africa. Obviously, the DRC is the biggest producer of, well, certainly the second biggest producer of copper in the world. It's the biggest producer of cobalt in the world. The Zimbabwe, lithium, chrome. South Africa's got exports 70% of the world's manganese. So that's a really, really powerful place for our region to be placed. And obviously there are constraints, settlement, etc., etc.
No, excellent. And we'll cover what the challenges are and how we might overcome them. Fatima, what is your view on what the opportunities are from your industry perspective?
Whilst I support everything that Colin said, and I agree, I have a slightly different perspective, and that's purely because I'm with DHL Express. So we transport urgent, time-critical, super-sensitive shipments, and that has a different angle and a different perspective that needs to be considered. And for us, really, what we see is that there is so much potential on the continent. Traders are trading smarter, trade is moving across borders, but what we have is complexity that was already referred to here. 54 different customs regimes, 54 different sets of documents, 54 different approaches to tariffs. etc. So for us, the opportunity lies in simplification, and the opportunity lies in something that that was chatted about in the fireside earlier on, AI, and the role that technology will play in simplifying the clearance of those goods, the movement of those goods, the tariff coding of those goods across border. And so you're wondering, okay, well, simplification, how is that an opportunity? Well, it's an opportunity because it will enable our SMEs to more effectively trade across borders, and that's where the key is. 80% of the employment of this continent lies with SMEs. 90% of the contribution to the GDP in most of the countries in Africa come from SMEs. Yet they are the ones that are mostly excluded from trading across borders due to the complexity. They don't have the appetite, they don't have the skill set, they don't have the support to be able to do that. So the opportunity lies in organizations like all of us on this stage right now, engaging in partnerships with governments, customs officials, etc., to ensure the simplification of trade across borders.
Excellent. I think simplification we can all buy into. But Gabriel, there's an interesting connect here. You mentioned earlier about payments, and if we can make payments more instant, that would create opportunity for us. And of course, DHL is talking about moving urgent, goods across the continent. You would imagine instant payment has got a big role to play there. But just connecting those two dots, and then just generally for you, what do you think the opportunities sets are for us in improving trade in the continent?
Yeah, thank you. I think the focus has to be on the smaller micro enterprises environment. It really is where the future growth is going to come from. And so when we consider the flow or value exchange with small and micro enterprises across the continent, do we really believe that we've got visibility of the flows? And I think that the reality is no, we don't. I think we see some of it, but the formalization of those flows are important, and it's important for three things. It's firstly important for credit. It's important for insurance purposes, if you think about the logistical angle, and thirdly, it's important for working capital.
Yeah.
And working capital, not just in terms of allowing those businesses to grow, but working capital also then to expand the access to markets that would increase those flows. Now, from our perspective, we look at that and we think, okay, well, could we then drive some exponential growth to lift that 15% of intra-Africa flow? But if we were to consider those 3 points that I've mentioned, specifically around the credit and working capital, we need to ensure that from outside, from a global perspective, the inflows into Africa is done in a cohesive way that's got the necessary availability, happens instantaneously, and then open up those environments for additional trade. And so to do that, we've done a lot of work over the last 3 years to position a service called MasterCard Move. It's available across 200 markets globally, with more than 150 settlement currencies that actually allowed those flows. And considering the smaller micro enterprises environment, it's absolutely fit for purpose for allowing that value exchange and allowing it to happen in a clear and cohesive manner.
No, interesting. We always talk about mobilizing large capital flows, particularly for things like infrastructure and energy on the continent. But the two of you have raised the importance of supporting SMEs in moving goods across the continent, because that supports another level of growth and employment on the continent, which is critical. And nobody thought 10 years ago that remittances would be one of the largest sort of flows of capital into the continent as well. So we've actually got to look right across the spectrum and not be overly focused on one area. For you, Cyril, just what do you think the opportunities are?
No, thank you very much. I think for the past 10 years, the bank looked at trade enabling. So we carry out a questionnaire every year where we look at the trade finance gap on the continent. We share this questionnaire with the different players in the market, and we get feedback. So we got a list of the reasons why the trade finance gap then was low. It was not where it is. We actually believe it is not 15%. We do believe that there's a lot of trade that is not captured yet in the data, in the statistics. The trade that happens across the borders, so there's still a lot of work to do. But in terms of the opportunities that we then tried to develop out of the feedback that we got from the respondents, we created the Africa Trade Gateway, which we call the ATG. In the Africa Trade Gateway, we have tried to create an ecosystem that enables traders in member states to access, it can be SMEs, it could be large corporates, to access what we thought were some of the things that were missing in the ecosystem then. We talk about information, transparency, who knows this entity? The bankers call it know your customer information or customer due diligence information. So at Afreximbank, we created what we call the Mansa platform. Mansa allows you to upload your information, incorporation documents, identifications, and once you put it there in this secure platform, it enables everyone that wants to trade with you or interact with you know that you're a verified entity in country X with this address. Because that was one of the challenges that had come out of the questionnaire. The other one is, of course, Pan-African payment and settlement systems, which we're very, very excited about. We looked at the over-reliance on the hard currencies to settle trade that is within the continent, trade between Zimbabwe and Zambia having to be paid maybe in paid and settled in Japanese yen. All right, and as a bank, we launched the Pan-African payments and settlement system, where we work with financial institutions to make sure that there is a way that the buyer and the seller can use their own currencies to facilitate and complete the trade. And then the financial institutions can do the currency conversion issue. It's not upon the buyers or the sellers to be shouldering this burden of managing the currencies. The other one is the trade link. Yep. The trade link in the ATG is more of the payables, and that speaks to our SMEs. Payables financing, where if we have an anchor buyer, we have one strong buyer that receives goods or is being serviced by very many small enterprises, we can actually look at this strong buyer. We give them access to this system, and all their customers will launch their invoices in this system, and if these invoices are verified by the strong buyer, we're able, as a Afreximbank, or using any other financial institution that partners with us, to release liquidity for these small-scale enterprises. The other is trader. Trader is more of information, market information, especially if you're in South Africa and you want to go and invest in Morocco, for example, in Egypt, where I work, and you've never been there. You can actually get access to the database and receive information about Morocco to a level that at least allows you to know, how is the market in Morocco, to build your confidence in your decision making. Yeah. So these are opportunities that we welcome, Standard Bank to join us, my fellow panelists to join us, and the audience.
Excellent. That is an exciting development. Bulelo, I don't know if we're charging for advertising space on the on the panel, but we'll send you guys the invoices. I've had 2 sales pitches while we're up here, so we might as well balance it out. Colin, just talk to us from your point of view, your entity. What are you guys doing, and what do you think? Maybe you want to profile in practical examples of how some of your initiatives have unlocked or are unlocking trade. It's a free sales pitch.
Free, thank you. Yeah, so the opportunities I touched on, but obviously the challenges are such that basically we break it down to three challenges: infrastructure, regulation, and counterparty settlement and forex volatility. The opportunities are, I mean, the friction points are, as I touch on infrastructure. We are on a mission to re-rail commodities through Southern Africa, and everyone who has played in the Southern African pool will know that rail has been sidelined for many decades, and we've successfully debottlenecked some of these corridors by putting in our own rolling stock and signing access agreements with some of our neighboring countries. And we've done that successfully for the last 10 odd years. And that is just, those opportunities are expanding, you know, every year as the exports out of our region increases. And like we heard Felix talk about Zambia's ambitions of taking copper production to 3 million tons. Congo is at 3 million tons. We're talking about 6 million tons of copper that the world is looking for. And so debottlenecking infrastructure is really what we spend our time doing, whether it's ports, railways, corridors, etc.
Excellent, thank you. That's incredibly valuable work for the economies. Fatima, I have to give you your sales pitch as well.
Yeah. Again, same but different. The key challenge really does lie in infrastructure, but different perspectives of infrastructure. You know, Colin has spoken about ports, etc. With ours, perhaps I'd like to touch on the air connectivity gaps. And I have some colleagues here from the aviation sector, and they certainly know, and they have a strategy on how to address that. But one of the key things we know is a primary challenge in Africa is the cost of logistics. And the cost of logistics is significantly higher than any other continent simply because we have these air connectivity gaps. The cargo space availability in terms of direct routes linking African countries, neighboring countries, etc., in the continent is a real hamper. More often than not, we have to leave the continent to fly back to the continent. And that is a huge cost and obviously impacts traders on the continent. Secondly, added to that is this concept that I'll just touch on very briefly, which is the de minimis. Now, I'm not sure if many of you understand the de minimis, but in essence, it's the taxes that countries charge for imported goods and the levels in which they determine that. And we still have very strong protectionist strategies in the countries in Africa. It's very often seen as a great source of revenue for countries, the duties and taxes on inbound goods. But there's a different angle that I really want to point out around the challenges. And that is because those de minimis are so high and they protect local business, what they enable them to do is to become complacent and uncompetitive globally. So they are not cutting edge, they are not driving their products forward like they should be. And at the end of the day, the African consumer is the loser. So those are some of the challenges. I mean, there are many others that we can touch on, but to give you two different perspectives to perhaps what we have discussed.
Thank you. And I have a new word which I must pronounce correctly, de minimis. I'm happy to open up for Q&A whilst we've got the panel on stage. Any questions? There's one, two.
Thank you, Crosby. Richard Callan, Professor of Law and Governance, Cambridge University Institute for Sustainability Leadership. I was reviewing a paper we commissioned last night on financial flows into Kenya. And the paper argues, and I'm kind of extending my remit to you to peer review it with me here. The paper argues that there's a lot to be learned from the digital transformation technology stuff that happened in Kenya, M-Pesa, for example, iconic project. that kind of innovation, do you think that could break some of the barriers? Are there good lessons to be learned that could lead to, I'm kind of looking at you, Fatima, that could lead to the financial system renovation, ecosystem transformation we need? Thank you.
Thank you. You can answer, Fatima, but I think, Gabe, you might want to as well from MasterCard. Let's take the second question, so we'll give my panelists time to think about an intelligent answer. There's one more here as well.
Thanks. A quick one, just to pick up on the conversation around the role of infrastructure, and specifically I want to, if maybe Colin and maybe Fatima, insofar as the role it has and the potential for industrialization point of view, as you indicated in your opening remarks, you spoke about a lot more of exporting of raw materials rather than finished goods. Thanks.
Cool. We'll take the answers and then we'll take one more question after.
Yes. So my question is more related to the first one and perhaps addressed to Gabrielle and Cyril. And it's about the impact of stablecoin, and we know that Africans have, are great users of cryptocurrencies generally speaking, but I want to stay on stablecoins in particular, and to what extent actually your initiatives are taking into account that new way of transacting. Thank you.
Do you want to start transformation of using M-Pesa as a background and then stablecoins?
Yeah, sure. So I think M-Pesa plays a critical domestic role currently, and I think that the proliferation of M-Pesa since 2007 has, I think, been just absolutely astounding. I was participating in a talk last week, and according to the GSMA, total flows globally for mobile money is sitting at about $1.8 trillion, of which 1.4 trillion is in Africa. And of that, M-Pesa's got a massive chunk. So I think to not recognize the importance of M-Pesa is a big mistake. I think the challenge, though, is that we are increasingly operating in a world that's mobile first, and that requires almost ubiquitous digitization across all different types of flows. So if you think about mobile money, it was predominantly predicated on the domestic send money home use case, the ability to allow urban workers to send money back to where they come from. And I think that what we require, if we were to consider intra-African trade, is some sort of uniformity around fostering interoperability, the alignment of value exchange between governments from an interoperability perspective, where we recognize that ultimate digital value exchange has to meet the requirements of governments when they think about their own ambitions from a digital public infrastructure perspective, but also then satisfy the requirements of a new upcoming Generation Z that wants to be digitally native, wants to see instant settlement, and want to make sure that there's some level of standardization in terms of those flows. So I think as an endpoint, or as the last mile, if you want, I think M-Pesa's got an absolutely critical role to play. And I would then extend that to say that M-Pesa becomes an example of account-to-account based payments across the continent. And the success thereof could be predicated on the ability to drive interoperability, and to do so almost at the utility level with a cost base that could be equal to or mimic cash.
Yeah. Cool. Colin and Fatima, standing between coffee and the rest of us.
So we
On the
answer
infrastructure
the
question,
infrastructure deficit, what impact it has on intra-Africa trade, and yeah, absolutely, it's brutal. It's brutal for our continent, and I'll give you a very quick example. To import sugar from Brazil, your ocean freight from main port Brazil to Cape Town is about $35 a ton. To road haul sugar from sugar producing area in South Africa, Durban, to Cape Town is $45 a ton. So there's a $10 differential between road transporting from Durban to Cape Town versus Brazil to Cape Town. So we should be shipping that sugar from Durban to Cape Town, or putting it on rail from Durban to Cape Town. And I'm not saying that's the demise of Tongaat Hulett at all, but that is a real live example of how are poor. And yes, we have got poor logistics infrastructure to move the kind of commodities and to industrialize our sub-region. I hope that answers your question.
That's true.
So again, a slightly different and an interesting take on the same infrastructure is around the fact of the type of infrastructure that needs to be used. Colin references, road, rail, port, etc. Our interest lies in the aviation and the air infrastructure. And again, it's the same thing, right? If we can get the different modes of infrastructure working effectively, the industrialization growth in Africa will assist us and will then help drive exports. Why is that important and how does that tie to aviation? Well, it's very simple. A plane flies into Africa full to the brim because we import so much. But it has to go back there to come back again. So airlines have a double rotation. The problem is only one rotation is full and the return leg is going out with 10, 12% capacity. So when you're working out the cost per kilogram to ship an item, you have to work the cost per kilogram on the total cost rotation of that plane. So therein lies the conundrum around, yes, you want to get it out there quickly and you want to import your goods quickly and you want to export your goods quickly, but the cost of doing that is so significantly more. So we have to be able to fix the infrastructure that Colin's talking about. We have to be able to fix the intra-Africa trade to get that industrialized capacity up so that we have exportable volumes. Yeah. And the second we have exportable volumes, you will then get the drop in the logistics cost, and it'll all become, a circular kind of situation, constantly feeding each other.
Awesome. You've done 2 plugs and encouragements for Ethiopian Airlines that I've.
Well, they owe me. I'll be collecting after this.
Excellent. Thank you very much for your attention. I know we held you to coffee, and then thank you for my panelists. It was a great discussion. Thank you. Thank you.
A phenomenal panel discussion. Thank you so much, Mr. Mkhwanazi, as well as the various panelists for joining us and giving us some insight. Not only moving goods and services, but moving our money too, as well, which is quite critical. Speaking of that interlude to Ethiopia, we're going to have a vision session on Ethiopia in about 10 minutes' time. We will take a brief comfort break just to allow you to stretch your legs, grab a cup of coffee, come back with some refreshments. But please do come back, because at 11:30, when you are seated, we will start the session promptly. We'll hear about Ethiopian Airlines as a case study and also engage in a question and answer session with the CEO too. So please stay with us. 11:30, we'll be back promptly. Thank you so much.
so awkward. Thank you. I said just softly in here, but more outside. Ladies and gentlemen, please make your way into the venue and take your seats, or we may begin with the next segment. Thank you.
Thank you so much, everybody, for making your way back. Excited to see that we've had our refreshments. You're more than welcome to bring them inside with you, as you have had an opportunity to network, engage, and of course have robust conversation. As I afford you 2 minutes just to settle down, we want to ensure that we're able to build up on the key conversations we've been discussing throughout the course of this morning and the last 2 days. To whet your appetite, though, I do want to remind you that there will be a breakaway session after lunch. That is where you'll have the opportunity to deep dive into the various investment cases of the countries that have been showcased here in the room today. Those sessions will be taking place concurrently. However, we will share feedback with you as to how those particular conversations will run. One mainly here within this main plenary, and the other conversation further down the passageway as you pass the coffee station to the other end. That is where the second venue will take place for the conversations that will run concurrently. If you've signed up on the app for these conversations, you're more than welcome to follow the directions and instructions as per the app. If not, we do have representation throughout the course of the room and the floor to guide you as to where we'll go for those themes. You are more than allowed and welcome to enter any breakaway conversation that perhaps has piqued your interest or speaks to your area of insight, even if you haven't signed up for these conversations. So please do be mindful, if you perhaps neglected to sign up via the app, you will be afforded an opportunity to gain access to any of these conversations as they run concurrently after our lunch schedule. But we build up on 2 more themes before we get to lunch. Before that, we will have a conversation on all things impacting South African reforms. We'll also take a look at some key outcomes with regard to China and its next phase of growth. But before we get there, we're building up on a question that might have been built up by Fatima in the previous conversation on all things to do with logistics, infrastructure, and the capital that's needed to unlock the Africa Continental Free Trade Area Act. And one key company came up in terms of its name, which is Ethiopian Airlines. By now, I'd like to believe, how many of us, perhaps by show of hands, have been on an Ethiopian Airlines flight? That's telling. That's telling. Can you even come to the continent without getting onto one, is the question we should be asking. But that is to give us some context around the relevance, the importance of this particular institution. We know that it's highlighted several levels of investment, even expanding and building new local airports within its region and market, but also coupled with that has 3 key strategic partnerships right across the continent to ensure that it's able to move people, goods, and cargo across the continent. To tell us more, we are going to hear more about the vision of Ethiopia in particular, using Ethiopian Airlines as a case study. Should there be time, I am made aware that today is a tough day for all of us. We have time constraints in terms of logistics and travel arrangements. So our guest does have a hard stop at 12 midday. Should we have time for Q&A, we'll try to facilitate it and squeeze it in. However, there will be opportunity to engage with many more counterparts who will still be present in the room. Ladies and gentlemen, we're going to deep dive into understanding the way ahead for Ethiopian Airlines. And for that, we're going to hear from the Chief Financial Officer to help us unpack more about the business's strategic growth, development, and opportunities that exist, Mr. Adamu Tadele. A warm round of applause, please, for him.
Good morning. First of all, I would like to thank Standard Bank for inviting me, Ethiopian Airlines, to this important event. It is really amazing. It's my first time here, so I didn't expect this much money involving in this room, and it's a very good opportunity to showcase what we have done so far and what we are doing and what we plan to do in the next 3-4 years. First of all, I would like to start telling you a little bit about Ethiopian Airlines. Of course, many of you know about Ethiopian Airlines, but I will start just explaining a little bit about it, and then secondly, I will present about the mega airport project which we are just started building. I will start with the history of Ethiopian Airlines. Ethiopian Airlines was established in 1946. Our first scheduled flight was to Cairo. While celebrating our 18th year in 2026. In 1960, we started our first operations to West Africa. We connect Accra to Dakar to Addis Ababa, following the establishment of the Organization of the African Union. The first jet service was started in 1962. So we connect UK and China in 1973. And it continues in 2010. We started a new vision called Vision 2025. Vision 2025. It is after that which we embarked in a very huge growth. We start growing. We established an airline group in 2017. Okay, yes, fine. Then we established an airline group in 2017, which was the establishment of the Ethiopian Airports Enterprise as part of the group of Ethiopian Airlines. We are also running a hotel, Ethiopian Skylight Hotel, which is also part of the group. These are the major key facts about Ethiopian Airlines. We are a member of Star Alliance since 2011. Just finishing the year in June 2025, we transported 19 million passengers and just over 784,000 tons of cargo. Our revenue stands at 7.6 billion. Our current fleet in operation is about 148, and we have 124 aircrafts in order as well, with average age of 7.7 years. Our main hub is in Addis Ababa, with multiple hubs in Africa, in West Africa, Lomé, Southern Africa, Longé and Lusaka, and in the Central Africa, Kinshasa as well. Our current destination is about 144 international and 23 domestic operations and 70 freighter operations with dedicated cargo and as well as belly hold of the passengers as well. We are employed 20,000 plus full-time employees. Ethiopian Airlines, as you know, it is 100% government owned, and currently we are operating about 3,000 weekly flights. The number of fleets currently in operation, as I said, is 144. The 45, we're operating 26 SL50 aircraft, 30 787s, 23 777, 4 767s, 36 737, mainly MAX aircraft, and 28 Dash 8 Q400s. Passenger number, when we finish the financial year, as I said in June 2025, it is 90 million. Revenue is growing. It was decreased during the COVID time, but currently it is 7.5 billion US dollars. We're running a diversified the aviation business group with strategic business units, Ethiopian International Service, Ethiopian Cargo and Logistics Services, the Ethiopian Express, which is mainly the domestic service. We are also running the hotel, Ethiopian Skylight Hotel. We have a huge MRO for our own and third-party maintenance. In-flight catering, Ethiopian Aviation University, ground services, and Ethiopian Airports Enterprise. The MRO has 6 hangars and a capability of airframe maintenance, the engine maintenance, component maintenance, line maintenance, aircraft on ground, OG service, and third-party maintenance as well. The Ethiopian Aviation University, it was for a long time an aviation training center, but now it has increased to an aviation university, pilot training, maintenance technicians training, School of Marketing and Finance, cabin crew, leadership training, full flight simulator for 787s, S350, 737 NGs, MAXs, Q400, 777, 757, and 767 fleets as well. Currently, its annual intake is about 4,000 trainees. The university is approved at the level of postgraduate level in aviation training. Our catering facility, one of the key parts of the group, it can produce 100,000 meals a day. It meets industry standard hygiene analysis and critical control points. And it's one of the key strategic parts of our business. Ethiopian Airports, as I said, the airport has become part of the airline group since 2017. Currently, this is Bole Airport, and it also manages 22 domestic airports in the country. Skylight Hotel, it has more than 1,000 rooms, just 5 minutes walk from the Bole Airport. We constructed in 2 phases. The first phase was 373 passengers, and the second phase 651. And we have also in-terminal hotel with 97 modern rooms. We have a long-term vision, actually mostly 15 year strategic vision. When we finish 2025, we finalize our vision 2040, which is the 15 years roadmap. And the corporate goals, we are planning to be one of the top 20 leading the competitive and diversified aviation group in the world by 2014. Our annual revenue is projected to be 29 billion from the current level of 7.6. We will operate 356 aircraft from the current 145. Our passenger number will increase to 63.9 from the current level of 19 million. Number of destinations will be 290 from the current 144, 145, and domestic operation to 47 from the current 24, and the cargo from the current 785,000 tons of cargo to 1.9 million. That's the target for our 2014 strategic roadmap. Our growth will be fast, profitable, and sustainable. The diversification will continue in different aviation-related businesses. We'll continue to have multiple hubs in Africa. The cost leadership is very important, integrated cost leadership. That is one of the key aspects of our success. And we will continue to invest in our 5 pillars, which are: we will continue to phase in modern fleet with modern technologies. That's one of our pillars. We'll continue to invest on our human resource. Our aviation university will continue to train pilots, technicians, and most importantly, the leadership training will also continue to give this vital development activity. Infrastructure is another pillar, the third pillar, which is we continue to build cargo terminals. We'll continue to build MRO centers, and mainly the Bishoftu International Airport development is one of the infrastructure developments which we plan to accomplish in the next 15 years. We'll continue to invest on system. Yesterday, today, it was discussed about AI and its impact on the businesses. So we'll continue to adapt to changing environment of the current technology. And of course, we'll continue to operate in behaving and invest on sustainability in line with the sustainability development goals. The second part of my presentation will be to tell about the Bishoftu International Airport, which is we consider it as an African project. This morning it was discussed about less connectivity in Africa, and mainly the main reason for this poor connectivity is because of lack of airport infrastructure. So we plan to develop it. We'll ask why this new airport is required. Currently, Bole Airport was, when we construct Bole Airport in 2008, the capacity was about 6 million. Then we continue investing on Bole Airport, and we improve it to 25 million passengers a year. And that number is almost there, and really it has become very difficult to handle more flights. If you fly via this, the terminal is congested, the parking area is very congested, so this new airport is required. In 2014, we appointed the airport de Paris to assess, mainly to conduct 2 activities. Number 1, to study if it's possible to further extend the Bole Airport, and number 2, to conduct a feasibility study on a new mega airport. So further expansion at Addis was not possible, so the only possibility was to build a new airport, and that's why we're going to build it. Demand is expected to surpass this capacity of 25 million at Bole. So the city development and around Addis limits further development. As the airport's altitude, it has also a payload penalty. So the development of the Bishoftu International Airport is therefore, it's a must-have, a need. It's not just something which is good to have, but we have to have that in the next 5 years. We take the land. It is 39,000 hectares of land from the regional office. The resettlement is finalized. People move to their houses, and that's going very well. We have invested so far for the resettlement about $350 million US. The scope of the Bishoftu International Airport, it will be constructed in 2 phases. First phase will be 60 million passengers, and the second phase will be another 50 million. When it's completed, it will have a capacity of 110 million passengers a year. We have Dar is our technical consultant. The feasibility study is finalized. The environmental and social impact assessment is done. The geopolitical investigation report is finalized, and the concept design for the terminal building, airside and landside infrastructure is also finalized, and the project cost estimate is also finalized by the technical advisor. So the total estimated cost of the project will be $12.5 billion US. For land and resettlement, we invested so far $740 million US. For early works package, which is started in January, it's paid about 25%, and the airline will cover $633 million US. The lump sum turnkey cost, the infrastructure, airfield and landside, will cost us about $1.7 billion US. The main facilities will cost us $3.9 billion. The support facilities, which includes offices for the airport and the airline, will cost us 1.4, and the off-site link, the link between Bole and the new airport, will cost us $954 million US. Financing and other related expenditures will be $3.1 billion. The total project cost will be $12.5 billion US. The financing status, with the help of our consultants, DAR, the financial advisors, KPMG, the initial mandated lead arranger is the African Development Bank. The mobilization activities already started. We are seriously engaging with most of you in this room and elsewhere as well, and it's going very well. The financing structure will be the project finance modality with a limited recourse special purpose company to be established and lead the airport. All the current ownership and the operation activities will be given to the special purpose vehicle, and this special purpose vehicle will own with the ring-fenced cash flow collection as well. The debt equity ratio will be 30-70, 70% debt and 30% with equity contribution by Ethiopian Airlines. Just to say on the project timeline, the project information memorandum and financial model is already released by the African Development Bank. The groundbreaking and the early works is started on January 10, 2026. The January 31st, complete shortlisting of the pre-qualified contractors is finalized. February 28, this week, we'll complete final design and present infrastructure and 8% of the main facilities ready for tender. The March 3, RFP will be sent to the shortlisted EPC contractors. And by August, we have to finalize the award to the contractors for the main construction. October 9, contract signing with selected main contractors will be finalized. The loan approval will be by the end of this year. Then the financial close is planned to be end of first quarter next year. And the commercial operation commissioning will be the 1st of January 2030. That's the timeline. Just to show you, we'll run the video and then we'll continue with the question and answer. Thank you for listening.
Imagine a place where you can rise high above, A place where you can find peace, comfort, and wellness. Imagine a place where you can rise to Cloud 9. Directly connected with Addis Ababa and the Bole Airport by high-speed rail, the new Bishoftu International Airport is a central node of a new regional transport system. Its vibrant airport city creates strong investment opportunities beyond the terminal itself. The new airport is home to Ethiopian Airlines, the award-winning Star Alliance carrier. Carefully tailored to Ethiopians' needs, Bishoftu Airport provides a world-class travel experience with a special focus on transfer traffic as the global hub of Africa. Every traveler passing through the Bishoftu Airport has a unique experience of Ethiopia. The terminal is bright and airy, with luscious, open-air gardens accessible on the airside, landscaped with trees and local vegetation. You can touch Africa with your own hands. The most discerning travelers and loyal passengers have access to the Cloud 9 Lounge within its own dedicated building at the center of the terminal, featuring exclusive dining, rest areas, spa, and a gym. The terminal's interior is planned as a set of buildings within the main structure. Together, they form a small city. Each neighborhood is defined by a set of volumes containing shopping, dining, and airside hotel accommodation. Efficiently constructed as a modular kit of parts, the new terminal is cost-effective and flexible, providing a long-term return on investment for the nation. The new airport at Bishoftu is a microcosm of Ethiopia, drawing from the colors, textures, and materials of different corners of the country. Different regions characterize each terminal pier, centered around the central spine of the Great Rift Valley. Arriving at Bishoftu Airport means a warm welcome to Africa, with the embrace of Ethiopian hospitality and immersion into the airport's lush gardens, providing respite from a long journey as you wait for your bags. Naturally ventilated, semi-enclosed spaces minimize energy consumption. A LEED gold-rated building, Bishoftu International Airport is the most climatically optimized terminal in the world. The new Bishoftu International Airport, a new gateway to Ethiopia, the crossroads of a continent, and a gleaming portal from Africa to the world.
A round of applause, huh? I think more than anything, many of us are really looking forward to seeing much more of this kind of innovation and the support that continues to be unlocked, as has been highlighted. We're aware that we're under pressure for time ever so slightly, but I do want us to squeeze in at least 2 more questions from the audience if we can, just to ensure that we do cover any aspects that we might be missing out on. But Mr. Ademo, I'm quite keen just to hear your thoughts and perspective that came through from a previous comment in the panel that was before yours, where Fatima had a critical question to mention or statement regarding the unlocking of the Africa Continental Free Trade Area Act. How typically you fly from one part of the continent, but before you get to the next Pan-African country, you actually have to go outside of our region. So I'm quite keen to understand, this is but one of 3 airports, if I'm not mistaken, that's going to be constructed. Help us understand, outside of moving people, how does this support the movement of cargo and goods to facilitate the opportunities presented by the Africa Continental Free Trade Area Act?
Okay, thank you. Yes, that's definitely a valid comment. For a long time now, both passenger and cargo, to travel from to a neighboring country, it was really required to go to Europe, to Paris, or to London and come back to Africa. But I think we're solving that problem, because the fact that we're following multi-having strategy means in West Africa, ASCA is doing very well, connecting West Africa to the Central Africa.
How many flights do you have between the 2 regions per day?
We're flying to six destinations in Africa now, so lots of flights definitely we'll have. But the thing is, there are these freedoms of the air. We're not allowed to take passengers from one country to another. For example, we can't take passengers from Lagos to Accra. That's not allowed. But cargo is not a problem. You can move cargo between 2 countries. But very important on cargo is the discussion this morning about the African free trade. So cargo should justify to deploy a flight between two African countries. That's still very thin. We are bringing cargo either from Europe or Asia and Middle East to Africa. As explained rightly by Fatima, it is directional. One direction you'll bring, but when you go back, it's empty. So sometimes it does make sense to operate the one directional. Operational costs are expensive. In Africa, the fuel is exceptionally high in many airports in Africa, almost double what we have in Europe and Middle East. Landing, handling costs are very expensive. Even navigation expenses are very expensive. Because of that, yes, the movement of cargo is still not really smooth between African countries, but we're trying.
Got you. Worth trying, and of course calls for ongoing partnerships to unlock some of those blockages there, whether it's regarding the fuel costs, opening up our airways, diplomatic conversations that also need to be aligned on to make sure that next time you're sitting in Ghana, you can have coffee from Rwanda. The next time you're sitting in Zambia, you'll be purchasing gold and wearing gold items from a fashion designer who might be based in Ghana, and maybe even in a different market to experience the dynamism of the continent. We're keen to get 2 questions, or maybe we'll keep it to 1 in the interest of time. If anyone from the audience does have a question, we're more than happy to take it. I'm seeing shoulder scratching, head scratching, but no hands in the air. Okay. Going once? There's a hand. We'll come to you, sir, if the roving mic could come to you. Please let us know where you're from, too, so that we get some perspective and we'll get a quick fire response from Mr. Adem.
Good morning. My name is Mpotla Kudi. I'm a journalist with Bloomberg News. My question would just be on the financing cost of the project. What is the underlying reasons behind such what I'd say a high financing cost for such a project?
Okay. Yes, yeah, obviously we're saying that this project is bankable. In the last couple of days and this morning we were talking about lack of infrastructure in Africa, and the main one is airport infrastructure, honestly. So there are lots of interest from different banks which wants to build, but it is encouraging to hear that there's lots of money in Africa as well, 12 African projects. So we encourage commercial banks. We are planning to mobilize from the 3 tranches. The ECA, as it was discussed in the last couple of days, we import so many things to construct this airport. So the ECA tranche is 1, but DFIs and the private equity and the commercial bank source is also strong. So we encourage African banks to coordinate. African Development Bank is believed to connect DFIs and commercial banks in Africa and raise a substantial amount of money. So the financing is there. It's just a matter of coordinating and telling to financial institutions that how this project is visible.
Got you. Again, seeing some of the innovative examples there. I'm tempted to ask, Standard Bank CIB involved in this particular deal at all?
Oh, yes, yeah.
Okay. We'll leave it there. We'll get back to it because there's clearly a lot more conversations to be had around the cost of financing and, of course, the cost of the debt as well, which is the theme that was being discussed. Mr. Adamu, thank you. We'll squeeze in one more question.
Yeah, sure.
From Mr. O. Go ahead.
I'm just, Lars Boylesen, OPay, so in payment business. So I was just wondering if, do you have to make equity investment in Africa to gain access to the continent, or do you not plan to do that, or will you just continue doing today? I used to be on a board of a European airline, so we were very inspired by Ethiopian Airways, how you expanded.
Okay, what makes this project special is the airport is part of the airline group. So for now, what we are saying is a project financing model with limited recourse, ring-fenced cash flow can be managed. So yeah, for now, we don't really plan to have equity investment in this airport. So we want to finance it in a 70% debt equity ratio, and we are mobilizing that for now.
Got you. Thank you so much, and a very valid question. There's a lot more for us to peel back the many layers to this particular theme, but we do understand representation from Ethiopian Airlines will still be with us till the end of the day. But Mr. Adamo, I'm told you have a flight to catch, quite literally.
Yeah.
So we appreciate your time and contribution again, and all the best going forward. We look forward to seeing the outcomes. A round of applause, please, for Mr. Adamo.
Thank you.
Joining
Thank
us
you.
today. As we reflect on much of the conversations that we've been having this morning, I think more than anything, it takes us back to the initial presentation we had between Shola and David, who gave us some perspective around some of the perhaps predictions we've made about growth on the continent, but also just how viable much of our projections have actually been. And that actually spoke to themes like reforms, some policy shifts and changes when it comes to our monetary policy stance, ensuring that from a logistics point of view, we do see some interventions taking place. And as we've heard, there have been various visions for various countries and many more that we'll get into the investment case studies after the lunch session. But our next session speaks specifically to one of the most industrialized economies on the African continent. We're based in it, we see a lot of activity in it, and most importantly, we also see ongoing challenges regarding South Africa's economy. But opportunities still prevail. And we say this because we're well aware that there have been interventions from reforms, additional support in terms of business and confidence and capital following through with these themes. This is where our next panel discussion goes to take a look inside South Africa. And this particular conversation also comes at a poignant time, given that tomorrow, National Treasury will actually present their budget speech, giving us insight and highlights into their fiscal positioning and what that looks like in the short to medium term. Critical because that will also help us understand how further they look to unlock many more of the reforms that have already been implemented. To guide us through this conversation, we have several leaders, all with whom come with a wealth of experience, either in the logistics environment and freight rail, offering guidance in terms of economic policy, both to commercial partners or even government itself, but also giving us some context around some of the opportunities that have been generated and supported when it comes to power capacity in the country. I'd like to introduce all four of our panelists, as well as the moderator who will be joining us in conversation, helping us understand some of the outcomes regarding reforms as well as progress in South Africa. This conversation will be moderated by Trudy Makaya, who is a partner at BCG joining us, as well as a former economic advisor to the President, Mr. Cyril Ramaphosa. She'll be joined in conversation by Mr. Rovaningo Mnisi, who's the Group Executive for Renewables at Eskom, followed by Mr. Soli Litswalo, who's the Chief Operations Officer at Transnet, and advocate voice for investment in South Africa, Mamokete Dijane, strategist for global markets at corporate and investment banking for Standard Bank. Please give all our panelists a round of applause for this particular discussion. Again, there will be a Q&A within this particular 30-minute conversation, which will be facilitated by Trudy.
I think we need to move on. Thank you so much for that kind introduction. And maybe our panelists could come closer. I know we're standing between you and lunch, so we'll try to keep this crisp and to the point. I think just 2 days ago, I saw a headline that said, the stars are finally aligning for President Ramaphosa. And it was, of course, in reference to a lot of the positive economic signals that we're seeing. People are sometimes very cautious about whether to call it green shoots, a turning point, etc. But we'll get into that in this panel. Many of you might be aware of the South African government's reform program, anchored in Operation Vulindlela and other initiatives in partnership with the private sector, which has seen a very focused set of actions in electricity reform, in logistics reform, and the water sector, in visa policy, and also in the digital economy, where we're starting to see some of the outcomes of those reforms. So I'm going to start with the panel just to ask them to reflect on whether we can truly say that we've turned the corner, and what are the indicators in their own sectors that suggest that we are on the right path, as the first part of the conversation. And then in the second part of the conversation, we'll then drill deeper into their own operations to determine how they see the changes that they're going to experience, that they have experienced, and also what they see as the risks and opportunities for their companies as anchor utilities for the South African economy. We also have the macroeconomic perspective from Mamoketi, who will anchor this in how investors and the markets have reacted to this. So perhaps we start with logistics. If we think about the rail sector, if we think about Transnet, what are the outcomes that we think would best demonstrate that we've actually moved from a state of policy design to actual operational delivery? What are the sectoral and other indicators that point us to this direction?
It's good afternoon. I suppose the question is for me. All right. I think those that could reflect back where we were some 2-3 years ago, 4 years ago, the media was only reporting negatively about logistics. And you will find that most of the mining companies that are major customers of the Transnet logistics system, whenever they reported their financial results, they would say that it's declining and it's constrained by logistics, by Transnet. So that's where we come from. If you look at the most recent reports, you will see that in the headlines, they're talking about growth, and they're attributing it to the improvement in logistics, which has obviously enabled them to move a lot more volume and obviously report higher revenues and income. So that is a big and easier indicator for that. Just logistics, as we know, if it doesn't work, the country comes to a standstill. Transnet operates pipelines, ports, and rail. And imagine if the pipeline had to stop operating, Gauteng will run dry totally, and it will be very constrained. And similarly, with the ports come to a standstill, no exports, imports, and the rail, obviously, even though you can bypass it with road, you don't have enough capacity on road to operate in this country without rail. So that is the value. Now we're seeing that there is a change in the last two years. If you look at all the indicators, they're showing positive growth, and that, for me, it's an indication that we've turned the corner and the country is on the right path.
So the country is on the right path, we've turned the corner. Let me pose a similar question to you, Rivo. In terms of the energy sector, can we make the same claims beyond, I suppose, some of the, we see the lights are on, but when we look at the real indicators and the sustainability of the sector, do we see that we have the right outcomes or that we're in the right path?
Certainly. I can assure you that we're on the right path. And I think the number speaks volumes in terms of what has been happening over the past 3 years. I think if we can take a moment just to reflect, currently, as we speak, the electricity system is stable with over 4,400 megawatts of capacity available to spare. If you then go back to how we started the year, this year in 2026, we are materially, systematically much stronger than we've ever been in the past 5 years. Thirdly, in the current calendar year, we are sitting on 98% electricity supply reliability. And I think the last time we remember, it was about 2 years ago, where we set below 10%. And further to that, we've also returned Eskom to profitability, where we've made 23.9 billion profit before tax, which then allows us to reinvest the funds back into making sure that we maintain a sustainable system, and most importantly, making sure that we align to the future of Eskom. We're currently in a position where I think the issue of load shedding is largely behind us, and we are focusing our attention on building the Eskom of the future. And what do I mean by that? Is that we're currently approximately sitting on 6.5 gigawatts in cold reserve, which provides us the opportunity to support industrial growth. And secondly, it also provides us the opportunity to look at local industrialization. I come from manufacturing and mining background, and we all know that those industries drive our economy, and they need a reliable base load to support that economic growth. So with 6.5 capacity, it really means that the work that Operation Vulindlela and the reforms that we're seeking to achieve are certainly on the right path. And lastly, we are currently introducing what we call Eskom Green as part and parcel of also capturing value within the green economy that is emerging. But we're under no illusion that such initiatives from Eskom will also require us to learn from other countries that have done similar reforms. And when we benchmarked ourselves against these other countries, we've seen that there's mainly 4 things that we need to be mindful of. Firstly is the rules-based reforms. Secondly is the policy frameworks that contribute to the security of supply. Thirdly is making sure that we deliver structured transactions, and which is supported by disciplined execution. And most importantly, it's invest in the regulatory space, capacity and capability building that is required at the regular to make sure that the reforms that we drive are structured and support the growth that we need as an economy.
Right. And I think it's important, the point that you make, that the economy needs a stable utility as the anchor of the energy sector. And we'll talk a little bit more about the market developments around that, but I think you've painted that picture. Now, let me turn to you, Mamokete. Are we just deceiving ourselves here? Have investors changed the way they talk about South Africa?
Yeah, I think that there's definitely been a change. So I'm going to sort of like try and cut this into sort of three sort of phases. The first one is when you look at what's been happening in financial markets, we've seen a lot of flows into the fixed income space most specifically, I think in recognition of the fact that the expectations around fiscal policy have stabilized, macroeconomic stability overall has been improved, or at least the outlook thereof. Because if you resolve growth, so part of the issue on long-term sustainability, it has, for South Africa specifically, been growth that's been below what we needed in order to maintain that. So as growth was undermined to a large extent because we're failing to participate in global demand, because we had massive binding constraints, the most important of which was Eskom, or at least electricity supply, and I think logistics from a cost perspective most specifically, and that undermined our growth for the period of a decade. We haven't really had the kind of electricity supply responsiveness that could support growth since 2008. So that's almost 15 years of suboptimal growth that we've had. And that's actually just accumulated into this massive debt burden that we had, risks around that, blah, blah, blah. Anyway, that seems to be resolved in the short term. But the interesting thing, and that's the question that we're all asking, is when does this then turn into growth? So if you look at how assets have behaved, you're not seeing the response from an equities perspective, especially on the part of the equity market that is concentrated on South African assets, right? So South African demand, etc. So we kind of like at this stage where we're happy with the stability, but we'd like for it to translate into better growth outcomes. So there are a couple of things I think that account for that. One could be that we've destroyed capacity. So just to give you an anecdote, I was speaking to, one of the road, actually Sunrock is the biggest road infrastructure investor, and they were saying, before there used to be 5 companies on the construction sector. So now you can have the financial capacity, but now you have 1 company. So the pace at which you can roll out that infrastructure is constrained. So there might be this gap between financial viability to when you can actually do things that creates a little bit of time where you're still working at this low economic growth. So that probably means that, you've got much more growth capacity going forward, but it'll take a while to unlock that. And I think that's reflected in how markets are responding. So, when you speak to investors, they're like, okay, we like the story, we like the reform story, we like the adjustment in the inflation target, we think rates should be lower, we can see that there's a cyclical story here around commodities, but where's the growth? And I think that's where we kind of stuck at the moment. So, fingers crossed. I definitely believe that we will make the transition, but it's just taking a bit of time here. And I think the proof of the pudding will be in the eating, so to speak.
I mean, I think if we look at many other emerging markets which have sustained increases in living standards, it often takes almost a generation of growth at 3-5% to actually make the difference. So I think that kind of is the aspiration that we should be holding ourselves, even as we, celebrate the moment that we think we're turning a corner. Let me return to you, Rivo. I think you started talking about, the future of Eskom in a competitive market, because I think in many instances and in many countries across our continent, you have a situation where the market opens up, and then the question becomes, what is the future of the utility in this, and how does it, continue to have a reason for being, and how does it, support its viability? So perhaps we hear a bit more from you in terms of what is that vision of an Eskom, but in a completely different market structure.
No, thank you, Trudy. I think what is important is Eskom has got a rich history, and I think about 103 years in operation. And certainly we're at a pivotal point in terms of the next 100 years. And how we see it is there's fundamental issues that are quite catalytic for the growth, and not only for Eskom, but for the country, because what we've studied is all the countries that have successfully implemented reforms have got a successful incumbent that supports that. And one of the things that stand out was the regulatory framework that they've put in place, one that supports the market operator. We're currently in process with NESA, making sure that the fundamental step toward market operations are in place. Secondly, is the approval of the grid rules, which means transmission access is now governed by clear rules-based grid capacity allocation, ensuring fairness across for the private sector and also for Eskom. Thirdly, it's also the market code, making sure that it's finalized. It's currently in its final stages of development, setting out how the future market will function. Together, these things, these initiatives facilitate development of a liberalized electricity market, which we're really after. And finally, I want to make the point that our minister in the electricity and energy said that they're currently in an advanced stage of advancing 7 independent transmission projects, and the private sector response was quite positive. I particularly refer to this example because this will also enable bespoke finance instruments like the credit guarantee vehicle to make sure that it assists in accelerating investment in transmission. Secondly, it's also a move away from bid window exercises, which allows us to take a longer term view, which also attracts further investments. I see Eskom in terms of the future being not only viewed as a monopoly, but rather as a partner. what we've seen as well is that CEOs are now turning and coming to speak to Eskom, particularly mining CEOs, because they're exposed to mining cycles and commodity cycles, and they tend to also have a challenge when it comes to prioritizing capital for their renewable energy projects. And with stability that they've seen and with our interest to partner with them on the green electrons, they're now turning back to say, look, we'd rather partner with you to deliver these green electrons. And these were some of the reasons that they've given us as the main reason as a partner into the future. Firstly is the fact that Eskom provides a system-level scale, stability, and shared infrastructure, which we believe other projects cannot offer. Secondly, they also mentioned the fact that there is an opportunity to stay connected to a fast decarbonizing grid. A lot of these IPPs are connected to the grid. The work that we're doing with Eskom Green is also connected to the grid, which means it allows big players or economic players to stay connected to a decarbonizing grid. The third aspect is also the fact that it became clear that we're not competing necessarily with the private sector, but rather we're looking for partnering in a manner that integrates into the national system for energy security and stability. And lastly, maybe if I may say it as a parting shot, is that Eskom, it's actually a partner that is looking to transition together with the industry players, and most importantly, do so competitively and at scale, which is the opportunity that we have as well.
So Eskom seeing itself as a partner. I think
Definitely.
In a previous life, I once worked for a competition regulator. So hearing people extolling the virtues of competition and embracing it, I think is heartening to hear and important for the performance of the economy. Let me turn to you, Soli, in terms of then Transnet itself and the path that it's been on in the journey in terms of private sector partnership. And how that has evolved. What's the journey been like, and how do you see yourself potentially also as a partner?
Thank you. I think what most public or citizens don't realize is that we already have public-private partnerships operating in Transnet. If you look at the oil, fuel, and gas industry, the ports are all operated by private players, not by Transnet. And Transnet's role is the pipeline that links those port, fuel and gas facilities to inland through the pipeline, which optimizes that. On the coal side, the biggest coal terminal in South Africa and the only big coal terminal is operated by the private sector, 91 million tons, which is then linked by a publicly owned rail line. So some of those things. Then most of our ports around the country are operated by the private sector, not by Transnet. And sometimes that message doesn't come through. On the new partnerships that have been formed, recently from the 1st of January this year, 2026, the biggest container terminal in South Africa, which used to be called Pier 2, is now being run by a private sector and operated by a private sector in partnership with Transnet, but they're the lead, the managing partner, and they obviously running that as a privately owned terminal. There's also a new contract that was signed with for LNG in Richards Bay, a new company formed, Zululand Energy, in partnership with Vopec, in partnership with Transnet, are setting up an LNG facility in Richards Bay that will supply Eskom, Sasol, and others from that area. And that is, again, another partnership. And we have recently issued, as Transnet, terminal operating licenses in Richards Bay for liquid bulk, and also in Kucha for LNG, again, another terminal operator. And there's many of those in the pipeline for issuing out to market. We are currently working on a few of these partnerships. The first one and Richards Bay Park. It should be going out by the end of this month, which means this week, where it's a port itself and the supporting rail network to handle more than 10 million tons that we will be out to market for the private sector to obviously bid for it and build and operate and transfer. Then there is the Kucha terminal for manganese, doing between 16 to 20 million tons. And that also is going to market in the next few months. Again, port and rail combined, giving the private sector an opportunity there. The third one is the container corridor. I mean, this is the biggest corridor from Gauteng all the way to KZN, handling, I mean, potential between 2 to 3 million TEUs of containers, most of that on road currently. And that corridor will also go out to market, which can then obviously assist in moving this cargo from road to rail, but also increasing the efficiency. So there are those short-term ones. In the future, there are various other corridors that are in the pipeline, and many of them obviously bulk ones, but a bit more difficult, or will take a bit longer to put the business cases together and then go to market. So yes, Transnet does see the private sector as a partner. Transnet is trying to obviously crowd in the capital that's available out there, and in partnership with the private sector, then grow the logistics system to support the growing economy that we are now in. And I believe strongly that the economy is growing and that Transnet will contribute towards that growth. We have a mandate from the president of the country to restore the Transnet rail and port system to be able to handle 250 million tons. I mean, this year, we're probably going to handle about 170 million tons, and you can see the gap. And the installed capacity is there. It's about restoring it to a level where it can work efficiently and economically affordable for the rest of the market. So that's where we are. And that can only be achieved in partnership with the private sector. Thank you.
Now, Mamukete, what lessons do you think we are learning as we go through this process? Are we striking the right balance in terms of competition, but also the stability of the market, and also thinking about, still the social considerations that, I think as an African country, we always have to have at the back of our mind?
So I think, first of all, we just need the infrastructure to be there. We need accessibility. Electricity should be available. There should be rail capacity, etc. Whether it's built by the private or the public sector, I think is not as important as the fact that it's there, and it's cheap, or at least it's affordable. And I think the case of Ethiopian Airlines, just listening to that, which is essentially a state-owned enterprise, as long as it delivers what it needs to deliver, I think it's okay. I think in South Africa, historically, we have had mandate creep around, say, an Eskom having to deal with multiple mandates that maybe diverted attention from the core, which was cheap electricity at the end of the day. And if we can clean up those mandates, it would be, I think, quite helpful. Having said that, if you think about the scope of the reforms, we've got rail or logistics and energy at the moment. But in terms of what South Africa needs to do, this is not even, it's the most urgent, but it's not the full scale of the reforms that we need in order to make this country work for all its citizens. So, I was reading a report by the IMF, and they were talking about how, there's stuff that needs to be done, for example, on labor policy in order to create a way of including more people in the economy and lowering unemployment. The issue around formality, informality, the issue of how do we make viable small businesses, how do we lower the regulatory burden. Those are still issues that need to be addressed, right? And they're outside of the scope. The other thing that we're not talking about is over the long term, education reform. What do we need to do in that sector in order to, get people more included in the economy? So, I mean, there's a myriad of issues. One of the most urgent, that's actually become one of the most urgent after these two, is around criminal justice. And I think it was mentioned here around, the construction mafias, etc., and the cost that imposes on business. So there's so much to do. I kind of think this is old news now. We kind of we're carrying on that front, but we do need to start thinking about what does South Africa look like when it's working for everybody. And this is a necessary but not sufficient start.
Yeah. I think you have a lot of consensus in the room on that. But I think staying with these gentlemen who are with us, perhaps we have a moment for a question or two from the audience before we kick off for lunch. I'm not sure, is that a question? And you already have a mic. Go ahead.
Good morning, Peter Venn from Sariti Green. A question for Eskom, very quickly, and I guess it talks to bankability. Number one, you've done a fantastic job to alleviate load shedding, but now we're in the opposite issue of having an excess of supply. What is the plan over the next 12 to 18 months to utilize this excess supply to grow the economy and make Eskom more bankable? And then if you've got any comments on the municipal debt challenge that you face, and what are your plans around that? Thank you.
Thank you. So excess supply, municipal debt challenge for Eskom, and then for Soli and Mamukete, I'll just have one concluding thought from you before we break up. So maybe let's start with you, Rivo.
Thanks, Peter. I think one of the key things that we need to solve is the issue of pricing. We've got a lot of demand from our smelters, but the issue that is quite prevalent at the moment is the issue of pricing. There's massive amount of work. I think I've got a list of it. One that stands out for me is the fact that we're looking at reducing the ferrochrome smelters by 35%, which will therefore enable the uptake of energy. There's also work around medium to long-term electricity support mechanisms. All of this work hinges around the issue of electricity pricing. If we can reach an agreement and support by the necessary regulating structures, we will be able to reignite the economy, particularly around the smelters. The other thing around also making sure that you asked a question around the municipal debt. This is a really important question, and I think it hinges as well to the issue of Eskom unbundling, and that has been one of the key things to say, how do we sustainably make sure that we keep the debt? There's been 3 initiatives. One is around the support and by government to those municipalities. Secondly is also the intervention of Eskom to run some of those municipalities that are suffering. The last one is also the reforms themselves, where municipalities are looking at alternative ways of getting cheaper energy, and particularly the uptake of rooftop solar as also another way of reducing the burden on those municipalities.
Thanks for that. I think very clear responses to those questions. Shall we have concluding thoughts? Maybe Mamukete, and then I'll give Soli the last word.
Okay, so I think for me to conclude, to bring it back to financial markets, I'm going to get off my high horse and really think about how I think markets are going to work out going forward. I did highlight that right now you don't see this transmission from reform to growth necessarily, at least not in the moment. But I do think I made the point that there's probably going to be a little bit of delay as we build up capacity. But I also think that we're probably going to be underestimating how high growth is going to be, because there's a nonlinearity in terms of how these things work. So just as an example, bond yields have come down 400 basis points over the last 2 years. And that is going to be hugely supportive of investment going forward. There's a lot of projects that would have been unfundable at 12% that are now fundable at 5%. In real terms, you're looking at much lower rates of interest. We're probably not thinking about what that looks like. So, you fix the fiscus, it fixes your cost of borrowing, it creates a better environment, and that comes through with a lag. So I think we'll probably be surprised, touch wood, at how strong growth is in the cycle, and that we probably are en route to resetting growth in a meaningful and material way over the long term. But like I said, we do still need to do a lot more. And this actually creates the fiscal space for us to start to think about that if we make the right decisions.
Dr. the last word.
Thank you. Yeah. Transnet gave an opportunity to 11 train operating companies to set up their rail companies and then operate on the Transnet network. They will probably take 2 to 3 years to be ready. Now, more slots should be made available to the private sector and give more companies that want to operate on the Transnet network, give them opportunities to do that. However, there's investment that's required in rehabilitating the network to make more slots available. That funding, a combination of government funding and obviously private sector investment, either through concessions that we, as part of that, the process that we've started of concessioning this network in sections to the private sector to be able to then invest in the network itself, and then either in combination with investing in rolling stock and running trains on that network, or inviting additional private sector train operators to then run on the network. So the future of Transnet is in that format, where investment now in the short term to create more capacity for train operating companies in partnership with Transnet or in collaboration with Transnet to handle a lot more cargo. So as I said, when Transnet works, South Africa thrives.
All right, so we'll be hearing from these gentlemen again next year, where we'll be expecting to hear updates on the reform process. And from Mamokete, she said we're underestimating possibly how we're going to perform. So we'll see how we do next year. We won't hold you to the GDP figures, but the path of direction. But we heard about partnerships. We heard that reform is complicated, but that we are on the right path. So thank you to our panelists, and thank you, ladies and gentlemen. Back to you, Gigi.
Thank you so much. Another round of applause, please, for the panelists as they make their way off stage. Thank you so much. Really appreciate the insight there. Perhaps this is where my bias starts creeping in, because it's the day-to-day factors that impact many of us who happen to be based in South Africa regarding these outcomes. But a lot more partnership and ideas that can also be shared with many of our peers that we have across the continent, if we consider our trade relationships, exchange of talent, innovative solutions that come from other regions and markets like Kenya, Zambia that are present in the room, Ghana, just to name a few. Well, you might be mindful and remember the fact that we do have an opportunity to deep dive into the investor sessions, where we'll get more context and outcomes regarding opportunities that exist in the different markets represented here in the room. What we have done, in the interest of time, and perhaps with your collaboration, is just to ensure that for us to enjoy lunch, and then from lunch, then segue into the breakaway sessions, is that we'd like to ensure that we get through as much of the program before lunch. So what we'll do, as per the program right now, is to shift to getting some perspective around opportunities in terms of the recalibration regarding China, and we'll hear from the chief economist at ICBC to give us some insight on that, following which I'll ask that you still stay in the room just for us to get a refresher and a reminder of what we can anticipate in the breakaway sessions. Mr. Crosby Mkwanazi will be giving us some feedback there. He'll be joining us back on stage as the head of client coverage at Standard Bank CIB to give us some feedback and the close. So if we can just have more of your time in the room, we'll build up on the themes. Following the lunch, we will give you feedback, or before lunch, I'll give you feedback on the breakaway sessions and how they will run. But for the moment, are we still comfortable? I feel like we need to do a litmus test. Are our sugar levels okay? All good, thumbs up. I'm hearing yes, I'm hearing nods. I hope we thank you, fantastic. All right, we're all together. What has been phenomenal to hear throughout the last 2 days is not only the shifts that are taking place regarding geopolitics, where we are as the African continent, outside influences and key themes that we need to be mindful of. We've spoken about the West, we've spoken about opportunities in the Gulf, and yes, China has come up. But on the back of much of the news flow, changes in trade deals and trade relationships, and even themes that were mentioned on a panel yesterday regarding a heightened level of holding renminbi as a reserve currency within our central banks, there's a lot more that we need to be mindful of regarding the recalibration of growth within China as a market. To help us unpack this further, just before we prepare for lunch, we're joined by Ms. Ginny Yan, Chief Economist at ICBC Standard Bank, to give us some perspective on this. A warm welcome to her, please, as we do throughout the course of the program. It can be a little warmer than that. There we go. Thank you, thank you.
Thank you so much.
Thank you.
Thank you. I don't know whether it's good morning or good afternoon. Let me check. It's good afternoon. Hello, everybody. It's such a delight to be back in Cape Town, and it's my third time. Each time is slightly growing in time. My first time, I believe, was less than 24 hours. This time I'm given slightly longer than 24 hours. But yeah, I'm still to see much of what Cape Town and South Africa has to offer. So we switched the conversation a little bit, and I represent ICBC Standard. You could really understand ICBC Standard as a child of ICBC and Standard Bank. So as the offspring of our two stakeholders, what we do very much, and actually it's an exciting time to be representing China and Africa, ever more so than before, everyone, all of the investors, I'm based in London, as you can tell from my accent, investors interested in two things when we talk to them. Emerging markets, China. China is no longer considered by many investors as an emerging market. But frankly speaking, what I may say in my presentation to you, a lot of the themes you may have heard of, but I wanted to connect particularly with the setting and the context of a lot of the African themes, continental themes we talked about, and of course South Africa, which we just delved into. What I want to say is that, are we thinking about China and Africa in the right context? Are we really realizing the potential in the second largest economy in the world and potentially the biggest contribution not only to GDP, but also to people? Demographically, Africa is going to be producing the youthful population that we very much lack right now in the Western world. So just to unpack some of these themes, I wanted to start with something that we highlighted in our annual Outlook report, and that is the great reallocation. So in my presentation, I'm going to give you 3 Ds. My first D is diversification. Whoever you talk to, investors or corporates, the biggest thing that is on top of everyone's mind is diversification. What's driven that? Geopolitics, the differentiation in terms of markets, and the ever-seeking of safe haven assets. We used to think US Treasuries, but nothing, frankly, nowadays carries zero risk. But we could search for the next best thing, and what has happened is that global GDP growth profile, as you see from the slides here, has shifted away from advanced economies towards emerging markets. And what we will witness in the next 5 years, according to IMF projections, is that for the first time, emerging markets will not only overtake advanced economies in terms of GDP contribution, but also in absolute GDP size. So what I'm asking is that we are so used to talking about China and Africa being the biggest contributions to growth, particularly after financial crisis, because obviously there's a lot of room for growth, lots of reforms, lots of industrialization and urbanization to go. But really, do we understand where allocation of reserves, investment, capital is properly aligned with what this story is telling us? Are we looking at our portfolios and reserves to align with the current mapping of global growth? And the answer is no. Whether you talk to foreign institutional, sophisticated investors in Europe, in the US, when you ask them how much of your portfolio are in EMs or in China, minority. When you ask similarly the question back to Chinese investors, sovereign investors, how much of your portfolio is invested into emerging markets or non-Chinese assets? Very little. So I guess the story of diversification is not just, trying to understand how global asset reallocation back into China and growing markets, but also the other way around in terms of how we can also make sure that Asian and particularly Chinese sovereign allocation is also naturally flowing into emerging markets, in particular Africa, whom China now increasingly trade with, invest with and into. And this is one of the themes, and I think we'll start to really question whether the allocation of reserves, capital, portfolios are adequately looking at the alignment and what the global themes are telling us. So what we are seeing in official data is a switch away from dollar-denominated assets, including equities, fixed income, etc., into gold, mainly because of that safe haven status that I talked about, and mainly driven by central banks, but also into RMB denominated assets, so that red line you're seeing. So that is not a proportion, by the way, that is absolute amount, mainly because it features so little right now in terms of global, so still below 5% of global reserves. Let me talk a little bit more about the gold reserves, because as we can see from news flow, etc., a lot of central banks are piling into gold. And again, the current geopolitical dynamics mean that this trend will probably continue. Same across Asia, in Africa, and we see actually as a proportion of overall FX allocation, emerging markets actually allocate more into gold than many other advanced economy central banks as a proportion of total FX reserves. And that is really because the fear of depreciation of the currency, for example, traditionally, but also the underweight of, in absolute terms, into gold. So we see more gold purchases, particularly from emerging market central banks. And that includes China. And we see not only central bank demand, but also jewelry and consumer demand as well into gold and other precious metals. So diversification carries another meaning. And now I'm going to talk a little bit more about China's macroeconomics and where that growth came from. So in the previous panel, we heard so much about how South Africa is looking for where that growth is going to come from. In China, actually a very similar story. We're used to double-digit growth, fast growth in China. But actually, there is now less focus on the scale or the quantity of that growth. It's now about the quality of growth. So my message to South Africa and Africa is that maybe you can avoid some of the pitfalls that China made by actually thinking every single 1% of GDP growth, how much value does that deliver for the development of my economy? What is the quality of that growth to its people, to the corporates, and the dynamism that Africa has to offer? So in China, the story currently is that there is a relatively unbalanced profile when it comes to composition of GDP growth. China traditionally has been investment-led. Regardless of what media tells you, which is that China is export-led, that is not the case. And really, China's success in GDP growth comes from the fact that government-related investments, particularly central government, SOEs, which is quasi-central government, lead growth. If you say that Africa is, resembling of local governments in China, but essentially there's one government that leads, you're probably in a position where there is a central allocation of resources and investment. But China is very unique. China works in 5-year plans. And currently we're heading into the 15th 5-year plan. Now, next week will probably be one of the most important meetings in a second largest economy. It's the 2 sessions meeting. Every year, China in Beijing, there is a convening of the annual budget meeting where economic targets are announced, work report is being reviewed, but very little is talked about because people, especially I think media, it doesn't pick up headlines of what it means. But next week is the first 2 sessions in the current 15th 5-year plan. What does that mean? It doesn't just mean China will deliver its vision. For the rest of the world, especially the southern world, emerging market, we need to understand what China will be investing, where the flows will be going towards, and how China will trade and invest with the rest of the world, particularly the emerging world. So, in a nutshell, the challenge facing China is not the quantity of growth. Whether the growth target remains 4.5 or 5% is irrelevant in an economist's view, because every single percentage of that growth needs to now deliver productivity. We are used to China being stimulated by construction activity, property-led investment activity, but those traditional sectors no longer lead GDP growth in China, and I'll have a slide later on to explain why. So this chart gives you a little bit of insight into what the 15th 5-year plan means. And I can safely say I read it again. I read it all the time when I give presentations all over the world. But again, if you read the components of what the 15th 5-year plan entails, it has everything we've touched upon since yesterday. It goes into the importance of new technology, so away from traditional construction sectors towards more capital-intensive, new technology, the 4th industrialization, whatever you want to call it. But this essentially means China is seeking a higher quality of growth at the time when China's population is declining. So likely that labor-intensive industries will start to lose productivity. So the age of AI and the age of 4th industrialization is not a wishful thinking from China. It is actually a necessity. And the way that I look at why we think China has already shifted to the new economy, no longer the traditional growth model, is in fact, if you look at the components of some of these high-frequency indicators, and here we use the Caixin New Economy Index, is that a lot of the transformation and the industrial upgrading has meant that there's already been a lot of focus in capital investment versus labor input. And what we see is immediately in the equity markets. Post-Lunar New Year, we've seen another bout of bullishness in the onshore markets. And the reason being, not only the blanket tariffs is actually beneficial for China because it sees a lower rate than previously expected from the US, but also the fruits are starting to really bear fruit in terms of the investments put into some of those new economy industries, high-end manufacturing, logistics, robotics. All of these industries, a lot of emerging markets are starting to think about, but China is already there, not only in terms of initial investment, but in terms of providing the jobs, making sure that SMEs and private sector have access to funding to be successful in those new industries. And then secondly, I want to give you my second D here. So we had diversification. Second D is dynamic policy making. And the reason for dynamic policy making, when we talk about global interest rates, it's important to understand that benchmark interest rates in China hasn't worked super well because China is still not yet a consumption-led economy whereby people, use credit cards in order to consume. So just by lowering rates is not going to stimulate consumption. So the number one challenge for China is how to unlock savings and actually stimulate domestic consumption. So lowering benchmark rates has not had that effect. So what the PBOC has shifted to is this, first of all, very much a corridor effect. So different policy rates for different sectors of economy to deliver the ample liquidity that the PBOC constantly pushes to the relevant sectors, to the real economy, where it really is needed. And there's an 8-part measure. So a lot of this is not well understood by markets because a lot of this is really buried inside a lot of regulatory announcements. But in fact, a lot of that 8-point measure is focused at making sure the most vulnerable sectors, whether it's agriculture, carbon reduction tools for sustainability purposes, the services consumption, elderly care, these are more social welfare sectors rather than simply putting out or pumping through the liquidity at low cost of funding. So dynamic policy making has really been the key to success. Now, I've summarized a few data on China's interaction with China, but obviously we've heard a lot about it. But the key for me here is in the stock of investments with Africa. Obviously, I love to have the time to delve into specific countries, but as a continent, the good story here is not just about the scale of flows of trade and investment, but about the diversified nature of the sectors. So construction, mining, manufacturing, fair enough, but also others are coming through. And I think that in the coming years, we're going to see much, much more sectors coming into fruit. And then one last point, which I don't think is on this slide, but certainly in terms of how such investments are financed. China and Africa story used to be very much bank credit financed. However, China has shifted away from that traditional funding model too to encourage private equity, joint investment, particularly with development organizations, to and partner with other institutions to invest in Africa. And similarly, the other way, the flow should also be bilateral, because I do believe there is a lot of opportunities, particularly in renewable industries, high-end manufacturing, where there's lots of synergy between China and Africa. And this is particularly true as China is now fully integrated in the global supply chain. So remember I said China is not export-driven. It's because China is a nation that imports to export. So it's a processing trade. So this doesn't mean that China is consuming more or exporting more. It certainly means that China is deeper and deeper integrated into the global supply chain. Almost everything you touch, see, goes through China, but doesn't necessarily end up in China, nor does it originate in China. So we need to understand that trade dynamic better. Currency. So my last point is about debt sustainability, but not in the way that mainly we talk about it from a national level. But actually, debt doesn't have to be all bad, because the current theme is that Chinese currency, RMB, is appreciating. And currently, the softer dollar is helping that. But the key thing is that cost of funding is low. So in reality, fundamentals mean there is now more and more opportunities in the RMB market, both in terms of investment and funding. So my final message as my time runs out is that whether you're a corporate, a government, a Ministry of Finance, whether you're just an observer, do we understand the formats of funding, both offshore and onshore in RMB? So offshore CNH, onshore CNY. Panda, onshore, offshore, dim sum. And the reason being is that often or not, both channels of funding are very low, lower than hard currency funding. Very little tapped. But the beauty of this market is that Chinese investors are looking for RMB denominated assets. but there's not enough issuers in these markets. So my message this year, which is probably a little bit different from last year because the funding in dim sum has not become interesting until now. Chinese investors actually are looking for RMB-denominated assets, but increasingly looking at how to align with the global story of emerging markets. You may have heard of Belt and Road, for example, however you like to call it. But the way that portfolios are starting to shape in China too, as well as the Western investors, is to more align where the growth is. So again, my concluding remarks really is that diversification, not only for the West, also for China, also for emerging markets. Secondly, dynamic policy making. Dynamic policy making is exactly why China has not followed many other major banks, but actually sought its own path to make sure that dynamic policy making fits China's own model. And last but not least is debt sustainability. Not that China is indebted to the extent that it cannot finance it, but actually I'm talking about, are we looking at debt in the right, using the right instruments and the right channels? RMB is probably not on everyone's wish list, but have we started to explore it as part of your diversification journey when it comes to debt sustainability? So thank you very much for listening. I'm here if you have any questions, and I look forward to meeting all of you. Thank you.
Thank you so much, Jin. We could listen to you all day. I think many of us being a lot more enlightened in terms of the themes and context that we need to be mindful of, especially ahead of the next 5 years, which does give us some context around the continent. The region does need to position itself. As mentioned, in a moment we will break for lunch ahead of the schedule, so we should get to lunchtime at least about before 1:30. I do want to give you some context though. There's a lot of opportunity for us to deep dive into the themes we'd like to discuss regarding different countries and regions that are best positioning themselves for growth. Now that will be profiled in the breakaway sessions, where we will have signage that will support you in terms of various direction on the different sessions that will be held. 3 different sessions showcasing different countries, to name but a few: Botswana, Zambia, Angola, Zimbabwe, including the likes of Uganda, where in separate sessions that will run concurrently, discussions will be held. A reminder that you're more than welcome to make your way into any of those particular rooms, where you will be able to solicit feedback, and once the timer does run out, you just kindly requested to move yourself into the next breakout session that you want to participate in. So please do be mindful of that. We do have peers and colleagues on the ground who will be able to direct you as to where you should go. However, on the back of the many themes that we have discussed, and of course in trying to ensure that we all fully grasp just the level of camaraderie, partnership, and really working as a catalyst and enabler for unlocking growth across the continent, Standard Bank CIB has been very clear in terms of its mandate to have all of you here as participants in the room, as key collaborators, countries, regions, regulators, governors, business owners, and most importantly, as allocators of capital yourself, who themselves are actively participating and engaging in making sure that we solicit the growth we need on the continent. To remind us of this and to underscore this messaging with a message of gratitude, please warmly welcome to the front of the stage Mr. Crosby Mkwanazi, Head of Client Coverage at Standard Bank CIB, just to give us some perspective. From there, we will segue to lunch. Following lunch, please do follow through with the different signage that you have regarding the breakaway sessions. We'll hear from Crosby. We'll enjoy lunch. Following lunch, breakaway sessions will continue as per the guidelines that will be shared by my colleagues and peers in the continent. Gallery 8, which is this venue, and Gallery 1, which is straight across the atrium. But for the moment, much as we did when we started this conference and throughout the different sessions that we've had, very warmly, ladies and gentlemen, welcome to address us with a story, or rather presentation of gratitude, Mr. Crosby Mkwanazi, Head of Client Coverage for CIB. If we could give him a warm welcome, please.
Thank you. Thank you. I am once again between you and your meal, as I was this morning at the panel, so I see there's a trend there. Gugu, by the way, I had a friend who, when I first met him, used to tell me all the time that he was from a place called Juju-le-Toit. And I was confused for quite some time until I realized that he meant Guguletu as well. So I don't know if you go by that name as an alter ego of Juju Letois. Distinguished guests, Standard Bank colleagues, valued clients, Your Excellencies, would like to just thank you so much for your participation at AMC 26 that we've had over the last 2.5 days. The conversations as they were structured today were really about conversations that will lead to impact and transformation. And the way that we can assure that there is impact and transformation comes down to what we do after this particular session. And hopefully we can come back at AMC 27 with a progressed agenda that will show that everything that we discussed here was really insightful, but also led to practical outcomes that we were able to drive economies across the African continent forward as a group. You are the leaders that are here in this room as well as online, and it is up to us to drive that transformation from everything that we've seen over the last few days. Since we are short of time, I'm not actually going to run through the summaries of the last 2 days. I think there was enough participation and attention to everything, and I think Stephen Barnes yesterday did a very good summary of Sunday night as well as yesterday's events as well. But if I was just to call us to a very simple story that we heard yesterday from the former Secretary General Ban Ki-moon. He spoke about the fact that when he was born, it was just after the Japanese occupation of Korea. And after the Korean War had just broken out, where Korea was really at its poorest levels comparative to some of the devastation that we've seen on this continent. But many, many years later, Korea now sits as the only country in the world that was once a receiver of donations from many donor environments like the United Nations, and they are now one of the key donors into that environment. That is an amazing transformation that I think we should use as inspiration for us as a group. And let us be the ones in this room and online that are listening to craft the African story and the African version of the exact same story. That is the inspiration that I take away from where we are. AMC 26 was really designed to talk about how we drive Africa's growth, mobilizing of capital, driving infrastructure across the continent. And I think we've had amazing speakers. I really want to congratulate all the panelists and the moderators that have participated over the last 2 days. And I think we've come with a very rich set of information and skills that we can drive towards getting those outputs as a group. I want to thank Guido, who's our sponsor, our head of global markets, whose vision and his team put this together. The organizers from Standard Bank that have put an amazing event together, and really we should give all of them a round of applause. And then, of course, our MC and Program Director, Guguletu, I think you've done a phenomenal job over the last 2.5 days, leading us with class and exceptional professionalism. Just want to clarify, so the day's not over, even though I've done a gratitude sort of statement for us from Standard Bank. The sessions are still ongoing in the afternoon. Please go do participate, and then there is a lunch that's been provided thereafter. Thank you very much, and those traveling, travel safe, and we'll see you at AMC 27. Thank you.